All right. Live and direct from the office of Matt, the mortgage guy. Looks like I got somebody. I think I put the StreamYard link here. If anybody wants to go live and ask questions, I'm happy to. Tonight's is going to be a little bit different. It's just me. Usually I have a guest. We bounce stuff back and forth, and then we both answer questions. Tonight I decided go live, ask me anything mortgage. I've got comment after comment after comment that I've plucked from different YouTube videos I put out that I could literally go through all those. But my hope is that people are going to join us live. They're going to ask us questions. Jenny, I don't know if this was your question here, and if you wanted to jump on live and ask it, but I'll go ahead and answer it. So anybody watching or anybody who catches this on a replay, hope this video provides value. All I ask is that you consider subscribing to the channel. I put out 3 to 4 videos a week on all things mortgage, a little bit real estate, a little bit investing, but mostly as a mortgage broker, I'm putting out good quality mortgage info because there's probably not enough of that out there right now. So Jennifer, does a PPP loan hurt your mortgage pre-approval? It does not. And the thing about it is the lender's not really going to know that you got a PPP loan. Here's what will hurt your mortgage pre-approval. I know the first round of PPP, you could apply for it no matter what. And if you're getting PPP, you're more than likely self-employed, right? And so the first round, you could, for all intents and purposes, apply and get it no matter how your business was doing. You just had to show that you spent it in the 24 weeks preceding. The newest round of PPP, you have to show that you saw a big loss in your business. So that's going to be the bigger problem for your mortgage pre-approval than the PPP loan itself, because the loan isn't going to show up on personal credit, and they're not going to mind it. Even if it did pop up somehow, there was a deposit that was seen by a lender, they're not going to sweat it. But if you got the PPP loan because business was hurting and there's a big decline in your income as a self-employed borrower, that certainly is going to hurt. Let me see how this works. I guess respond in the comments, anybody who's there, if you'd like to join. I'd be happy to post this link. And if you log in here, you basically wait in the waiting room. I'll pluck people from the waiting room. You can go live. You can ask your question face to face. I think it makes it a little bit more personal. So I think it'd be cool. Let me see if we can add Jenny. Jenny, are you there? Oh, there you are. I think I added you twice. Jenny, are you there? Can you hear me? A scientist and all right. Jenny is watching cartoons with her kiddos. If it's the same Jenny that asked this question about the PPP loan, hopefully that answered it. Go ahead and do a follow-up question if you'd like, and I'm happy to answer it. Here's what I'm going to do because I think it's useful. When I went through and I was trying to figure out the most common questions I get, I went through prior videos, comments on YouTube. You there, Jenny? Hello? Uh-oh. No volume, no sound. We'll check back with Jenny. Thanks for joining again, Mail Cold. I appreciate your support. I think you've been on every stream. You're a VIP, man. Whatever I can do to help. If I'm assuming you're a dude, Mail Cold. But yeah, anything I can do to assist you in the future, I'm happy to help. This YouTube ride has been fun. I've been doing it just out of the pure joy of it. It's been bringing a bunch of business my way, but from the start, I wasn't necessarily hurting in business, and it wasn't something that I intended for it. I just thought that it was a good idea to put out good educational info, especially when I see all the garbage. That reminds me. This is something that's important. I screenshot something that I want to share with the world. I, like most of my listeners who have a mortgage, get random mail, phone calls, and now texts about refinancing. And I get the question all the time where people ask me, hey, Matt, is this legit? And they get just a random flyer in the mail that says 30-year fixed 2.25%. And they call me and we read through the fine print, and it's garbage mailers promising the world, and the fine print is super high cost and all that other BS. So I wanted to share this, and hopefully, let me see if I could put it up there. It was a cold, like, hey Matt, it's Kurt from a greater town. Thank you for your request on our website. May I communicate you via text? And I just said, which website is that? Because I don't remember filling out anything on any website. The website, it tells me the website, and I was reaching out to see if you're needing to get pre-approval for a home loan or refinance an existing one at this time. So somewhere I got a mortgage credit pull this year, either refinancing a property or buying a property, and people buy lists of anybody who's had a mortgage credit pull, and from that list, they're cold freaking texting me, just like straight up lying, right? Like I didn't fill out anything on a website. This guy was just, they're probably doing mass texts and trying to see who they can get to respond. So anyway, I thought that was interesting because marketers are trying new stuff every single week. I'm trying to educate as many people as I can, try to avoid that stuff, because unfortunately they keep doing it means it's working. It means that people are falling for that stuff. And you can imagine if you send out 200,000 texts and you get a couple fish on the hook, it's worth it, right? All right, Ross, let's see what you got. I want to buy an out-of-state home for myself down the road. Do I have to live in it more than 6 months out of the year to qualify for FHA 3.5% down? Okay, this is a really hot topic. It's a really amazing way as an investor to buy an investment property, because FHA, you can put 3.5% down if it's your primary residence and you plan to live in it for the first 12 months. And the verbiage from FHA says something like that you intend to occupy for the first 12 months. You can buy a single family, you can buy a duplex, you can buy a triplex or a fourplex. So for a first-time investor, it's an amazing vehicle where you can buy a $400,000 triplex, maybe, depending on what state you're in, maybe $180,000 buys you a triplex. Put 3.5% down plus some closing costs and be in it for very little. You now have a place to live and 2 tenants paying you rent. The right triplex or fourplex, those tenants are going to pay your full mortgage and you're going to be living for free. In 12 months, 18 months, 2 years, you decide to move out, you're going to have all your rent paid for and then some cash flow. So it's an amazing thing. The answer to your question, Ross, is it's got to be purchased as a primary residence. And so when you sign loan docs, you never want to commit loan fraud. You intend to occupy that property for 12 months. I'll tell you that things change, and maybe 9 months or 10 months down the road, you meet your dream wife and you're moving from Arkansas to Texas, or you get a job transfer and you're going from New York to Florida, or whatever the case may be, right? You're not going to be, hunted down and thrown in jail for moving 10 months later. But when you sign, your intent is to occupy for the first 12 months. Hopefully that helps. Catherine G. Hello. I appreciate you. I see you commenting on video after video on my channel. And so I'm glad as well that you caught me live, and I'm glad that you're here. I'm glad that I'm providing enough value where you continue to come back and seek out the videos and leave me nice comments. I love the feedback. That's literally why I continue to make as much content as I do on YouTube. It's not because I'm getting rich off AdSense, and it's not because I need to do it, because I've got a thriving mortgage business that honestly without YouTube would be fine. But I really enjoy all the positive feedback I get from people like you, Catherine, that says, thanks so much. This was really helpful. All over the country, I get positive feedback like that, and I only lend in California. So everybody out there in Texas and Florida and Arkansas and Louisiana and, Chicago, Illinois, I love providing value, even though I cannot lend to you. I cannot make a single dollar off anybody in any other state besides California. So thanks for being here. Question for you. My wife and I both have VA loan entitlement. If I use my entitlement to purchase a home as a primary residence and my wife is accepted to grad school, continued in a completely different state, is she able to use her VA entitlement to purchase a home to live in the state that she attends grad school? You would have to have a lender run the entitlement calcs. And to be completely honest, I don't want to speak on it and have something recorded for the rest of life that I speak out of turn on. Trust me, I've done that plenty enough in some of my earlier videos where I said something that was completely wrong. And on this specific I believe she could. And it's just a matter of, I've got a great ops manager on my team who has a person at VA, and she's always running entitlement where, like, you live in Georgia, you buy a VA property there, you move out to California. A lot of people have enough entitlement to buy a home and finance it while they keep that VA loan back there. It's all a matter of how much entitlement you have. You have to run. There's some calculator. I don't know it honestly, but I know that's how it works. Al Bundy, another faithful Matt the Mortgage Guy follower, listener. I appreciate you, brother. Any news on jumbo loans? How are rates compared to conventional? Can they close fast, like 15 to 20 days? Al Bundy, good news for you, bro. I think it was St. Patrick's Day. I think it was March 17th that my favorite lender, United Wholesale Mortgage, came out with a new jumbo product, 10% down, up to $2 million, amazing rates, no mortgage insurance. For the lenders that I'm sending jumbo to, the rates are in line with conventional. They're not better, they're not worse. What happens is if you do 10% down jumbo and you compare that to a 10% down conventional, the rate might be slightly higher, but no mortgage insurance. So if you've got an $800,000 loan where you put 10% down on 880 or whatever it is, that loan, if it's in the right county, right, is a high balance loan with mortgage insurance. That rate's going to be slightly less. But then when you kind of do the blended rate for a 10% down jumbo with no mortgage insurance, it's pretty close. It's pretty close. My man, Mark McDonough, how you doing, brother? I think you're going live tonight too at 5:30, man. So as soon as I pop off of this, I'm gonna come check you out. Cash out refinance. That's a pretty easy one, and some people don't understand it. One, I just put out a follow-up to my original video, and it doesn't have any traction yet, but hopefully it gets it. The pros and cons of a cash out refi. If somebody owns a house that's worth $600,000 and they owe $200,000, they're able to do a cash out refinance if they qualify for up to, if it's their primary residence and it's a single family, 80% of what it's worth. And here's where some people get confused. You don't take 600 minus 200 and do anything with that calculation. You just take the 600 that it's worth, multiply that by 80%, and then you write that down. You say, okay, 480. That's 80% of what my home is worth, and that's your max loan amount. So if you owe 200, you can go up to 280. Maybe there's some costs involved, right? Lender costs, prepaid escrows and all that. So maybe it's not 280 in cash, maybe it's 272, but that's how much cash you can get. So that in a nutshell is a cash out refi. There's pros, cons, and I broke down a lot of that in my latest video. So go to my channel and check it out. You could probably share it with some friends. Mark, why not, man? It's a good one. In my opinion, it is. Lisa, thanks for joining us. You got a rate of 3.375. Is it a good idea to buy down to get 8-year break even? I would never do something that's 8-year break even. That's my personal preference. Because let's say that for math, I don't know what your loan amount is, but let's say it is $50. It cost you $4,000. Well, that's 80 months, right? So that's not 8 years. Okay, let's do it. Let's say it's $5,000 and you're saving $50 a month. That's 100 months. That's about 8 years, give or take 4 months, right? 8 times 12, 96. I'm good at math. One, most people stay in their same mortgage between 3 and 5 years. Two, $50 in 2021 and $50 in 2029. You're just banking that you're going to stay in the loan for 10, 15 years. I wouldn't do it. I'd take the 3.375 at no cost. It's just, it rarely makes sense. Something's going to come up. You're going to move and sell the house. You're going to want to do a cash out 6 years from now because you're going to have kids going to college. You're going to want to refinance it in 4 years and go down to a 20-year because your new plan is to pay it off as soon as possible because you're retiring or whatever it is. I don't think anything more than a 5-year makes sense. And I have a hard time recommending 5-year break even for people. Usually it's like, if it's within 3, cool. If it's more than that, you got to have a good reason. And the good reason can be, Matt, I'm on a fixed income. I don't mind this $3,000 or $4,000 that gets baked into the loan to buy the rate down because $1,600 a month is really what I can afford. Between Social Security and my other income, I make $3,800 and I want my payment to be $1,600. That's a reason where you might buy it down. You're going to stay in that house for the next 20 years. You're sure of it. But for most people, the new stats came out and people are staying in their houses for longer, on average of 10.5 years before they move. But the mortgage changes still on average between 3 and 5 years. So I wouldn't do an 8-year break even. That's my 2 cents. Catherine G. If you use some retirement loan as down payment or closing costs, can you also use the balance in retirement account as some of your reserves? Sure. Most lenders are going to look at retirement accounts depending on what type of account it is, and they'll only use a factor of it, meaning you've got 100,000 in that retirement account and only 0.6 or 0.7, 60 or 70% is going to count towards reserves. So if you're getting a loan that requires 15,000 in reserve funds and you've got 15,000 in the retirement account, aside from the down payment, and that's your reserves. And this lender says you can only, it's a 0.6 factor. So it's really only 9,000 of that 15, then you're going to be in trouble. So hopefully that makes sense. For anybody watching, listening, reserves are what the lenders ask for. Generally, they ask for reserves if you have investment properties or if you're getting a jumbo loan, and reserves means months of payments. So if you're getting a jumbo loan and the lender says we want 6 months of reserves, your payment is $3,800 a month, and they want 6 months of reserves. I'm going to do the math so I don't mess it up on the calculator. Sorry. I'm going to look like a dum-dum. 22,800. That's reserves. Or if you own investment properties, lenders are going to look at it and say, you own your primary, you own 4 investment properties. We want 3 months of reserves for each of those 4 investment properties. So between the 4 investment properties, it's $5,000 in payments. They're going to want 15,000 in reserves, 3 months of payments for all of them. And that's just because, it's more liability, it's more risk when you own more properties. They want you to have some money in the bank. They want you to be secure. They're looking out for you. Lenders, they got your back. Get the likes up, people. That's what I'm talking about. Ryan Harris, it's on my side, man. Where are the likes? I don't even think I can see the likes here. I'm just doing this through StreamYard, which, by the way, I like StreamYard. It's so easy. For somebody like me who's not tech savvy, log into StreamYard, I press go live, and I go live. It's just that easy. So I'm not looking at it in YouTube. But whatever the like count is, it's not enough. And Ryan, you're the referee now, bro. For the 25 people watching, for the people that are joining and busting in and out, the very least you can do is bust a little like on there. Thanks, brother. Ooh, what percentage of loans are jumbo these days compared to previously? I think the data is yet to come out, Al, because I talked about it on a previous video. I was excited about the lenders that I work with as a broker. Some had it, some didn't, some brought out new products, and I felt like this wave of new jumbos coming out. And I even talked to some people, I've got clients in San Diego and Los Angeles and San Jose and Santa Clara, all over California that are using these jumbo loans, especially this new 10% down jumbo, which is a really hot one. And they told me, I talked to this guy who's in the office, direct lender. Not only is it on, the mortgage broker side with wholesale lenders, but direct lenders and all lenders for that matter are coming back out, providing more jumbo products. It's a good sign that they feel good about the real estate market and they're not afraid to lend and do these bigger jumbo loans. But I don't know the exact stats. I would guess that they're up. I don't know how much they're up, but by default, some of these places, let's take the big high cost areas in California. You go up to $822,375 and still be a conforming loan. Then you got to get above that to be a non-conforming. So you're talking about $1 million plus purchase with 10% down, 20% down. Houses that I'm seeing my clients make offers on in San Diego. These aren't mansions, folks. So the 3-2 1,800 square feet that now cost $1 million. It makes sense that more jumbo products are coming out. Real estate's more expensive. Al, thank you, brother. No, thank you, Mark. You're the best. AJ, my dude. Good to see you here, brother. Thanks for joining. Can you explain a bit about debt to income ratio? What do lenders consider as debt? Great question. And this comes up all the time. So I'll explain it the best I can. where debt to income ratio, the lender looks at two ratios. And a lot of people say, debt to income ratio of 43 or 45, but they fail to explain the lender's not just looking at your total debts versus your income. They're looking at your total debts versus the mortgage and your total debts versus, your total income. Let me start over. You can't erase when you're live. But we're starting over on debt to income. Lenders look at two numbers, the front end ratio and the back end ratio. The front end ratio is total income versus the mortgage payment. The back end ratio, total income versus the mortgage payment plus all debts. And so here's an example. I'm going to use 10,000 as monthly income because it's an easy number. And I just want to make things easy. If the mortgage payment that you're trying to qualify for is $3,000, that's a 30% front end. And I made the number 10,000, 3,000 because it makes it for easy math. 30% of that $10,000 income is your mortgage payment. Now you've got student loan, car loan, all that other stuff that gets counted in, and you've got $1,300 worth of that stuff. So your back end ratio is 43% because there's $4,300 in total debts versus 10,000. Now, to your question, what do lenders consider as debt, AJ? Just the stuff that shows up on your personal credit report. So we're not worried about your AT&T bill and other bills that you pay that don't show up on credit. Stuff that shows up on credit are student loans, car loans, credit card payments, debt consolidation loans or signature loans you get at your bank. But if it doesn't show up in your credit report, lenders aren't going to hit you with it. Sometimes there's stuff that may or may not show up in your credit report that gets deducted out of your paycheck, child support or something like that. In that case, we are going to count it. And so there are some exceptions. I shouldn't say it, it's just stuff that shows up in your credit report. But for the most part, that's it. The car notes, the credit cards, the student loans, other type of loans where when we pull your credit and those auto-populate into an application, we're looking at that. And for the back end, which for most loan products, you're going to want to keep under 45. And when I say back end, I mean total debts plus mortgage payment. That's what we're looking at. So hopefully that helped. Thanks for being here, man. Appreciate you. How can large cash reserves affect the DTI? So when you have large cash reserves, when you say large, large is 2 million. 30,000 is not going to be considered large, but there are lenders that will look at a client who has 2.5 million sitting in an account, and you'll be able to use asset depletion. The thought couldn't come into my head. Asset depletion, meaning if you drew $5,000 a month, you would be able to draw from this and you can use that as income. They use a calculation, and different lenders do different, where they take it and they divide it by 360 or they divide it by 240 to figure out what your monthly number is. And you can do that with cash reserves. You can do that with retirement accounts, where if you have $2 million in IRA, I think I just closed one today like this, where we had 2 million or 2.5 million in an IRA, and the client just set up a $8,000 recurring draw from their IRA, and that can be used as income. Likewise, large cash reserves, you can use that asset depletion. So it's gonna help your DTI by adding to your income side. Miguel Ochoa, real estate investor. Can I buy a house cash, then do delayed mortgage financing or a different way of buying cash to get a loan without taking the hit like it was cash out refi? There's no real way of not taking the hit, like you're trying to do it as a rate and term refinance. But what I will say is this comes up a lot for investors that are trying to do something like the BRRRR strategy. And for anybody who doesn't know, buy, rehab, rent, refinance, repeat is how that works. And so you might buy something, Miguel, that's distressed, and you buy it for 200,000. You put 25,000 into it, and it's worth 325. As an investor, you want to be able to get that whole 225 out, or maybe you spent 40 grand in repairs. You want to get that 240 out. The rules around delayed financing are, if you buy it and then 3 months later you're trying to refinance it, no matter what it appraises at, it could appraise at $1 million. You are limited loan amount to your original purchase price, 200,000. And I will argue up and down YouTube up and down forums, people are like, no, you can write the repairs into the final settlement statement. Somebody did something like in 1997 and somehow it lived on the internet where they think they can like bake the costs in. The price you purchased the home at, if you try to refinance it within 6 months, is your max loan amount. I guarantee that. Okay. So 6 months later, you can do a cash out refinance, and it's still a cash out, Miguel. There's no real way to kind of do it as a rate and term. The cash out refinance, if it appraises now at 400, now depending on the property type, cash out refi to 70, cash out refinance to 75, depending single family, duplex, what it is. And that way you can recoup, all your initial investment plus the rehab plus even more, where you could be, getting paid to do the deal, which is what all real estate investors are trying to do. So hopefully that answered it. Jen Sabino, hello, you're the best. Thank you. You're the best for joining. Hi, how can you purchase a 2-plex, a 3-plex property as owner occupant, which I know you can, and get no money down since you're going to live in it? You can't do it no money down. You can do it with 3.5% down FHA. Is the only way to do it. If you're talking about no money down and your down payment assistance type stuff, that stuff varies state by state. My kind way of talking about down payment assistance is there's no free lunch. There's always strings attached. So be very careful with that. More often than not, it's limited to single family, so you wouldn't be able to use it on a 2, 3, 4. But 3.5% down FHA, you could structure that in a way where maybe the lender costs, title costs, prepaying the taxes and insurance, all that stuff is another 2.5%. So you need 6%. So if you buy something for $200, you need $12,000 out of pocket. Or you put the 3.5% down, you get the seller to give you a credit of what you need for the other costs involved, and you're just out of pocket the $7,000 for the 3.5% down. I don't know. I mean, depending on where you're at, you might be able to buy a triplex in some parts of the country for $200. You might not be able to buy a triplex in California, parts of California for less than $1 million. But that's what I would do. 3.5% down FHA if you're going to live in it. 203K loan. Can you fund the contractor you like and get refund from contractor after contractor receive funds from bank? No. That is breaking the rules. Everything that gets funded to the contractor through the loan has to be spent on the rehab. I'm fairly certain of that. That sounds a little shady, June. I wouldn't do that. When working on credit score and have a few credit cards, best to keep small balance on only one, other zero, or best to keep a small balance on each? Gosh, you know what, Catherine? I did a YouTube live with Sam Parker from My Credit Guy. This would have been a sweet question for him, because I'm not sure. My guess is that it wouldn't affect it that much. I know for sure, because this happened to me where I had a bunch of credit cards with zero balance and I left them that way forever, that my credit score started to hurt because there was no activity. They wanted me to play a little bit. And so I went and charged lunch on one of them and charged something on the other just to have some activity, and then still paid them off or left a $10 balance on there. But yeah, that's my guess, is that, maybe you keep a $40 balance on one with $1,000 limit and the other two paid off. But I don't know, or charge something on all three and pay two of them off, leave a balance on one. I think the magic number is between 5 and 10% utilization. So if it's $1,000 limit, you keep a balance of 50 or so. I'm not a credit expert. That's just my guess. I think you're on the right track, and you know that low debt utilization is going to be helpful. So I would say it's my best guess. Al Bundy, what are things that go wrong and blow up on a loan after the buyer signs the closing disclosure? Usually you're pretty far through the loan when the buyer signs the closing disclosure. What is a possible blow up a deal event is something changes with the credit profile, with the job, with the money that's coming to the down payment. That stuff, kind of regardless of how far you are along, can change a deal, can blow up a deal. And I've had stuff too where questions were asked, things were moving along, and all of a sudden it's like, oh, I didn't tell you that I'm leaving this job on the 28th and I'm going commission only starting next month. those kind of things can blow up a deal, right? You go from a salaried W-2 job to a commission only type job or something, and lender, no likey. I mean, I had a deal CD signed and buyer was going to sign final loan docs. He called me and said, "Hey, Matt, super, super nice guy. My job is ending the end of this month." And the final loan docs, I sent him a copy before he signed in front of a notary. They asked about if there's any changes in my job status. And he was the type of guy where he's like, "I'm not going to say no, even though I'm still working in this job and I will be for the next 3 weeks. I know this job is ending and I'm going to be out there looking for a new job." Sweet, sweet loan. Sweet loan we had set up for this guy. A refinance was going to save him money. And he just said, I'm not comfortable. And I said, "Either am I." Is what it is. Canceled the loan. We've got it still open at the lender. And I've agreed to pay for lock extensions where if he finds a new job with a salary that we can use, an offer letter that says he's going to be making whatever he needs to qualify, then we'll restart it. Or just, put that income in the file. We should be able to get the thing clear. But things like that and job change. And it happened more often than ever in this last year where companies were getting restructured or changing things in 2020 for COVID. Oh, yes. Catherine G. I appreciate you. A little bit of super chat. That is awesome. I learned about super chat not so long ago, and I think it's cool. My kids think it's super cool. When I get super chat, my kids think that I'm a YouTube star. So thank you for that. That was the one we just read. I'm not rushing to buy a house, but you think it's a good idea to wait till the program expires and see more inventory? You know what, Diego? This is amazing, amazing question. And tomorrow at 12 o'clock, I've got a video coming out. I just recorded it today. What if the market doesn't crash? That's my video. And I'm of strong belief, and in the video tomorrow at 12, you'll see that based on data, based on things that are happening, I just don't see a crash coming. The 2.5 million that are left in forbearance, every month that number goes down, where it's like 5.2% of people with mortgages, 5.14, 5.06, 4.95. And the more and more people that come out of forbearance, the more data we have showing they're tacking it on the end of their loan. They're refinancing, they're selling, they're doing everything but be in trouble. And I know, because I talk to people every single freaking day, that the vast majority of people in mortgage forbearance are not in it because they absolutely need it and they wouldn't be able to pay their mortgage payment. It's so easy to take. I clicked a couple clicks on one of the websites where I pay one of my mortgages, and I almost accidentally went into forbearance because it was like a highlighted area where I'm like, I thought the highlighted was where I pay, but the highlighted is like COVID relief. So check out that video tomorrow at noon, Diego. I think it's going to be a good one. And it's maybe not as popular as all the market crash videos, but we shall see. The market is crazy. You are right. Everyone is overbidding in New Jersey. Will the market get better anytime soon? Another one, Jen, check it out tomorrow. Like, so much stuff with the forbearance, with the fact that like 34 to 36-year-olds are a huge part of the demographic. And from 88 to 90, more and more of them were born. And so like that demographic is growing over the next few years. More demands coming, less inventory. Lumber is 4 times as expensive, so it's more expensive to build a house. We're pumping money into the economy by the trillions. Like everything that I see points to like there's no relief in sight. As much as I pray for it. As an investor, I want things to get cheaper. And I just don't think it's happening. Check out the video tomorrow. Al Bundy, is there a difference between 0 point and par? Nope, same thing. When somebody says that's the par rate, that means there's 0 points, 0 cost for that specific rate. And it's a common question. Face too much and mail cold both with super chat. Bam. Catherine super chat, appreciate you. Mail cold super chat, appreciate you. Really, really appreciate you guys joining. The super chat's awesome. My kids, when I go home tonight and tell my boys that I got 3 super chats, they are going to be so impressed. So thanks for giving me a little bit of clout as a dad of an 8-year-old and a 12-year-old, I'm going to be cool tonight with the super chat. Why would a perfect credit borrower go with FHA over conventional? Well, Al, I think the only scenario that I see that is on the 3.5% down buying a multifamily. Because if you're buying a 2, 3, or 4 unit conventional, literally April 1st, 2021, they cut out the ability to do that with 10% down. You could do it 10% down. It was like home ready and home possible. And now it's, as an owner occupant, I think you got to have 20. It's either 15 or 20. But the ability to put a smaller down payment on a 2 to 4 unit is really the only case where I think it makes sense. If you've got a 760 credit score and you're buying a single family home, no way in the world you're going to do FHA over conventional. Mainly because FHA has upfront mortgage insurance, meaning 1.75% of the purchase price or the loan amount. Man, I'm getting old. You got an upfront fee, $300,000 home, 1.75% of that. I'm losing my mind. Is that 5,250? 75 times 300,000. 5,250. See, I'm not losing my mind. You get charged that upfront, and then the 0.85 mortgage insurance factor. Let's just do the math on that. Times 0.0085 equals that much divided by 12. $212 a month in mortgage insurance. If you've got 760 credit and you're putting 3%, 5% down, your mortgage insurance is going to be less, because on conventional, the mortgage insurance is based on your credit score and your down payment. So at 3%, it's probably going to be better than the 3.5% down FHA. And at 5%, I guarantee it's going to be light years better. Probably this 212 and 5% down conventional is 60 or something, like a third. So only doing it if you're buying a 2 to 4 unit, or if your credit is subpar. If conversely, if you've got credit that's 640 and you look at a conventional loan, your mortgage insurance might be 150% of what it was as an FHA. And so in that case, FHA. But any seasoned mortgage professional is going to be able to kind of lead you in the right direction on that. So it's important to find somebody who knows what they're talking about. AJ, thank you, brother. I appreciate you. We've done business together, and I appreciate you being here. Hopefully, we'll do a couple more in the next few years. Let's get you to 5 units total. Are we being foolish offering $35K over the asking price? I'm from Massachusetts. I bought a house in 2020. My wife and I bought a house, and for a family member, it was fun. We offered $35,000 above asking, waived the appraisal contingency, and I feel really good about it today. Probably paid $60,000 less than what it would pay like sell for today. And so that's the thing, is I'm no crystal ball guy, but if you're gonna stay in it for long term, whether you pay $515 or $550, I think matters very little 20 years from now. If you're in Massachusetts now, but your dream is to get come hang out with me in California, and you're moving out here in 2 years, then I'd say maybe not, because market goes flat, rates go up, and then market dips 5%. If you're selling it for a loss in 2 years, which we don't know if that's going to happen, I don't see that happening either. That would be somewhere where you'd be foolish. But as a long-term investment, real estate's going to appreciate at a 3%-ish interest rate. You're going to be paying off principal a lot faster than you would if you had a 5% rate. You're going to be, having the tax benefit and all that. And so I don't think it's foolish at all. But again, I'm bullish on real estate, and that's that. Oh, you liked Sam. I'm going to let Sam know, Catherine. That was a good one. Credit and mortgage are really intertwined. I think people kind of underestimate the power of that, not just in mortgage too. What's something, Catherine, that I should talk about in future videos is like a debt consolidation loan where you pay off a bunch of debt through your mortgage for people that have mortgages. Not only can that save you tons of money, right? You refinance into 3 1/8 and you've got $70,000 in credit card debt at 18%. Not just that, but then, what if your credit score is 705 and paying off all that debt brings you up to 760? Now all your future credit that you get in the next 5 years, 10 years, if you get lower rates because of it, you got a 3.99 in your car versus 7.99 or something, that's valuable. But that's just me speaking. Okay, Matt, is it okay to shop for or change lender after offer acceptance? The lender that I was pre-approved with has a higher rate versus online. Oh, AmeriSafe. Michael Burko, run for the freaking hills. And I made a video that's called like, when do you choose your mortgage lender? And the thing that I said was that, like, do this shopping before you get into contract, because here's what's going to happen. AmeriSave has, this great rate, and I cannot find a positive review on AmeriSave the harder I try. Sure, there's AmeriSave and Better and some of these lenders that might be slightly better. Maybe 3.25 is a direct lender. I'm 3.1 as a broker, and 2.99 is AmeriSave. You win against 22 offers in most parts of the country. You were lucky enough to get your offer accepted, and now you're going to gamble that AmeriSave can deliver on a promise that I'd be afraid of taking that gamble. Personally, I would. You as a consumer can switch whenever. And I've seen it happen, and I've seen it more often than not be good, because what's going to happen is it kind of gives the seller an out to cancel. And if you were an aggressive offer that offered a 24-day close, or whatever it was, but there was 2 or 3 other offers that were close to yours, the minute the seller has any issues and you can't remove loan contingencies because they're slow and they're an online lender, like, you're talking to a guy in a call center that worked at friggin' Chick-fil-A 6 months ago. You're not talking to a mortgage professional. That's just how those online lenders with the thinner margins operate. Is their loan officers are all brand new, all making next to nothing, no reputation to protect. And it's nothing personal against them. But if you're any good, you're not working in a call center at AmeriSafe. If you're any good, you're out on your own, generating your own business. Great reputation. It brings in referrals, and you just do a ton of loans, a la Matt the Mortgage Guy. So that's my warning. Please don't do it. Please don't do it. Thank you, Nate. Pleasure having you here, my man. I appreciate you. My agent showed me a few homes with tenants in it. With COVID issues, should I buy a home with tenants? This is a tough one. Anybody hear about the couple down in Southern California bought a house in January of 2020? I think it was Riverside, California. And this wasn't even an investment property. This was for their primary. But the same thing can happen for an investment property. So this story is going to relate to your question, Jen. They were supposed to move in, and the tenant wasn't leaving. They told their realtor, like, hey, what's up? This guy's like not out. He said, I'm not leaving. And hired an eviction attorney, started an eviction process. Like, this guy's got to get out of our house. COVID hit. Now tenants have these protections from evictions. They can't get evicted. This Riverside couple who bought this house, this nice house, after talking to lawyers and talking to like law enforcement, they were in the wrong. They could not just like go bust down the door and say, get that out of my house. So this dude squatted in their house for a year after they had closed on the mortgage, and they were responsible for mortgage payments. They were the owners of this house. And so unfortunately, Jennifer, with the eviction moratoriums, like, we don't know. The U.S. government loves to kick the can down the road. And so it just got extended. Maybe they extend again, and you might inherit a tenant that just says, new owner? Nah, I ain't paying. If you get the financials from the current owner, and this is somebody that's always paid on time, chances are they'll continue to, because they don't want an eviction on their record. They don't want that on their record. And so you'd probably be safe, but it's something to definitely look into and make sure that your realtor's getting as much information as possible, because I would be, I've inherited plenty of tenants and I haven't really had any issues. I don't think I've inherited any in COVID, but I've had decent luck with tenants not being too bad during COVID. I had 1 or 2 that were, using it to not pay rent when they obviously could. And some that are having trouble because of COVID, I've just got property management working with them saying, hey, do what you can. We want to help. And most counties on that subject are starting to roll out, because I think they got $30 billion in the last stimulus for rent relief. So most counties, you should be able to get rent relief for your tenant. My property manager was able to apply for it on the tenant's behalf, because I've got a pregnant tenant who's out of work. Husband's receiving unemployment or something. And so we've been working with them, just whatever you can. We don't want you to get too far behind. Now this rent relief is going to come in, I think, catch them up. So I'll get paid as the owner. They'll get right as the tenant. So everyone wins. Nice happy ending. Are you licensed in Florida? I am looking for an investment property or second home. I am not, but if you shoot me an email, matt@mattthemortgageguy.com, I'll connect you with a great broker in Florida. I've got brokers all over the country that they like me. I don't know if they like me because I just send them referrals, or if they like me because I'm a nice guy, and at mortgage conferences when I go and speak and chat with brokers from all over the country, I'm providing value. Hopefully it's the latter, right? Thanks for all the advice. Is there a duration which one should wait for refi after initial purchase? Oh man, I love this one. Builder's lender is giving credit by higher rate, thinking of getting the credit and then refi. You know what? I shouldn't say this on live YouTube, but I've had plenty of people do exactly what you talked about doing. And the builder's lender sometimes is like the bad guy, because they strong arm people and they're like, you got to use our builder's lender. And so it's like, all right, you forced me to use their lender. I got the $5,000 builder credit, but oh shoot. I just got some ringing. Let me know if you guys can still hear me. All right, hopefully it's still working. Just got like some feedback and then a ringing in my ear. So you certainly could do that. If it's 3.5% and a $5,000 lender credit, then you can refinance it with a mortgage broker to 3.1%. I might. That's all I'm going to say. I'm going to try to stay hush on that. I bought a home in 2017 that was 1% down conventional with the other 2% paid by the lender. You know what's funny? I literally had this conversation. That was a cool product. And I am a firm believer there's so many people out there that have great credit, great income, everything's stable. They just don't have the down payment. And so I talked with a high-level executive at a lender about like, let's do this again. And what they basically told me was it's an expensive product, because in order to deliver it to Fannie and Freddie, who have their 3% down conventional, they've got to fund that 2%. So the lender, whatever lender is offering it, is going to have to internally fund that 2%. And so I think they were doing it by offering a slightly higher rate. And so there was like a lender credit that was crediting them. But I think people would still do that. I mean, if you could get in with 1% down versus 3, and I told you, hey, your rate's not going to be 3.1, it's going to be 3.375. Plenty of people do that. And here was my point to this specific executive I was talking to, because I talk to people every single day, and I can get somebody with a 580 credit score, an FHA loan. They have collections, they've got credit issues for whatever reason, maybe no fault of their own, but they've got, derogatory credit. They can buy with 3.5% down. If I get somebody with a 760 credit score that's been perfect, and they've got a stable W-2 income they've had for the last 12 years, such smaller risk, even though they're only putting 1% down. It's just a cost issue to the lenders. And in all honesty, face too much. The problem with any great programs right now is we've already got too much demand. So any Biden administration $15,000 home buyer assistance or anything like that is probably not going to pass. 1% down conventional is probably not going to roll out, because the last thing that anybody wants to do to a system that's already flooded with demand is create more demand. And so that's probably a case against we won't see it. But I believe in it. I believe that 0% down could happen and would be a good product if only offered if somebody was super responsible and showed ability to repay through everything else, right? Like maybe the debt to income ratio has to be lower. Maybe the credit is like minimum 720 or something like that. That is something that I would love to see from lenders. So I'll push it on your behalf because I sit on some of these advisory panels for some of these big time lenders, and maybe I have some pull. Maybe I don't. I probably don't, but I'll try. All right, June, do you think rates will go down later this year? I've actually heard that. Honestly, I've heard that, based on different metrics and different things they're looking at with how the stimulus is going to hit the economy and then how it's going to kind of fade out, we might see this temporary uptick that we've seen these first 2 quarters of 2021. And then towards like end of Q3 into Q4, we might see them tick back down. But I definitely wouldn't count on it. Anybody who's buying, if you like it, lock it is what I'm advising and what most people are doing. And then refinance is really just when it makes sense, do it. I've got a loan estimate. It's funny. I pulled up a loan estimate and a closing disclosure, and thinking about walking through it. If anybody wanted to kind of just walk through how to read one of these things. And I pulled one up from a client who, it was probably January. We never closed the loan, but we had them disclosed and we could have locked it at 2.66 on a 30-year fixed with no points being paid. And I'm thinking he wishes we could go back. Should have done that loan. Opted not to for whatever reason. So some people do that. They're trying to find the bottom. They're like, no, I'm not going to refinance yet. Let's just see if it goes lower. It went from here to here to here to here to here to here to here. It might go lower. And then people done missed out. After buy with commercial loans, when can I refinance? Thanks. I'm guessing you're talking about a property. If you're talking commercial loan to commercial loan, I'm not your guy. I'm residential 1 to 4 unit all day, every day. I'm driving very fast in my lane. I'm not looking at other lanes. I got great referral partners for commercial, but if it's commercial stuff, me's not your guy. Matt, the residential mortgage guy. Do you think lumber and construction materials continue to go up, or will we see a correction? I hope we see a correction. If you guys don't follow this guy on YouTube called Uneducated Economist, that guy's channel is all pure gold. I really, really enjoy that. I'm a big YouTube content. What do they call it? I watch a lot of YouTube content myself, and I love his stuff. He works in a lumber yard, and he's talked about lumber prices and how much they've gone up, and who knows the cause. I'm certainly not an expert to speak on why they've gone up as much as they have, right? But it doesn't seem like they can continue to go up. But that's me speculating from a seat of like, I know very little. I probably sound like some people that talk about real estate, and they're like, real estate can't go up forever, so it's got to correct. So let's see how that plays out. But it's an important thing to think about too, because like all these things that are going to help our inventory problem, and for most people that understand that at the bare minimum, like our supply versus demand versus supply problem, like very little supply, high demand. Like we need more building, we need more people listing their houses, we need less buyers, higher rates, whatever we need to do to equal these out. The more building part, even the ones that are building, it's $20,000, $30,000, $40,000 more to build a house. So the builders are charging more. And something I heard this morning that was crazy was D.R. Horton, the largest home builder, is now taking some of their developments and not even selling it to families, not even selling it to homeowners. They're selling them in lots, 124 units, bam. And then an institutional investor is buying and renting like $32 million somewhere in Texas. I had notes on it earlier, and it's part of my video that's coming out tomorrow at noon. And like, holy moly, they made 50% on that, where their normal profit margin is 20%. So why the heck would they just sell to individual buyers and have to worry about like creating an office and agents and selling them individually? It's a pain. Sell them in bulk. They got all this, bidding war and whatnot. It went up to 32 million. Boom, they're out. 50% profit. 124 units. That's gonna cause more of a problem with the little supply that we have, like barely 1 million homes for sale. We need that number to be like 3.7 million to be anywhere near a balanced market. So crazy. Oh, is there a chat over here? I didn't even know that was there. Sorry, Jenny. It's like an hour later, and I just saw that there's a private chat section in here. Shoot me an email if you're here for some reason. Shoot me an email at Matt the mortgage guy. All right. I'll square you away. Whatever questions you got. I guess there's a private chat where you can send private chat separately if you don't want it to be aired out in front of the world. Send it to me there, or an email, Matt, M-A-T-T, at mattthemortgageguy.com. I can answer your questions there. How complicated are construction loans or custom home loans? I'm not sure what custom home loans is, but I'm guessing you're talking about like a permanent to build or something where you're trying to. Oh, my dude. Let me answer this question real quick. Then I'm gonna bring on my dude Kyle. Construction loans are relatively complicated. That 203K loan, which is the most popular construction loan, there's a streamline where it's like less than 30,000 in rehabilitation. Then there's a standard where it's more than 30,000. And one of them, it can't be, foundation, it can't be structural, and it's a little bit easier. The one that's like a full 203K, it's a little bit more involved, but you can move a wall, you can add a second story, that type of stuff. From my knowledge, if you have the right lender and you've got the right people involved with the construction manager, there's somebody that gets assigned to you. I can't remember what their name is, but you could certainly do it. And in general, a house that needs like all kinds of repairs like that is probably something that isn't going to have all the insane amount of offers, right? And so maybe you can get your offer accepted on that. It's going to take you maybe 60 days to close because these things just take longer. But my advice is find someone who's really good at it. Find someone who that's all they do is 2 or 3K loans. I'm going to tell you straight up, I don't do those. And if somebody came to me, I would look at my broker shop with 130 lenders and I would say, who has done at least 10 of these in the last year? And I would refer you to them because I'm a firm believer in, I'm not going to take on things that I'm not really good at and ruin my reputation. And unfortunately, you probably will find some lenders that'll be like, oh yeah, I'll give that a try. You don't want to be somebody's try. All right, let's bring on my dude, Kyle Seagraves. Win the house you love. How you doing, brother?
I'm good, man. How are you? I'm in my car, as if that wasn't apparent.
Yeah, no worries. How the heck you doing?
Yeah, go ahead.
You're in Ohio, man. So it's like 9 o'clock.
Yeah, it's about 9. Yeah.
Was your birthday today or yesterday?
Today.
Happy birthday, man. You look a year older.
Well, thanks. I appreciate it. I know you can see the aging already. I saw your the StreamYard link in there, and I was like, I'm gonna hop on. Has anyone else hopped on?
I had somebody that tried to hop on earlier. I think she was having issues with her audio, but let me see. I'll put the StreamYard link on here again if anybody else wants to hop on. I mean, it makes it more personal, right? Where it's like you're actually there live asking the questions. Me and you can handle a couple questions as a tag team now that you're here.
Let's do it. I'm just sitting in the Menards parking lot.
This is an interesting question because I can answer for myself personally and then for your shop out there. Yes, my broker shop did sign the UWM addendum. Did you guys sign it, Kyle?
So from my understanding, we didn't have to sign it. There were a group. It seems like there were a group of people that signed, and then there were a group of people who it was what's the right word? If you unless you wanted to opt out, you were automatically opted in. So we didn't even, we're part of the agreement. We didn't opt out. And so we're a part of the agreement, but I don't believe that we signed. Now I'm not the one to directly sign for that anyway. That's just kind of what I was told from our broker, but yeah, so we didn't opt out necessarily. It's a very strange play though, Uh, I mean, I understand the mindset, and like I'm not a huge fan of Quicken or Fairway either, but I don't know. I can only imagine, like, could you imagine going to the realtors you work with and saying, hey, if you work with this other prominent lender in our market, you can't work with me. Like, what?
Yeah, but it's different. I mean, I'm super biased, and I'm gonna be
Yeah.
super transparent about this. Like, I sat on Matt's advisory council at UWM for 3 straight years. I got
Okay.
a personal relationship with Matt Ishbia, so I think I'm probably the wrong person to speak on this. But for anybody who's wondering what the heck we're talking about, United Wholesale Mortgage, who's the biggest wholesale lender by a long shot, 200 billion or close to it last year in production. They basically came out and issued an ultimatum to brokers, all the brokers that send in business, and said, you've got to either cut off sending business to Quicken and Fairway, or don't do business with us. And for all the people that said like you're limiting a broker's choice and stuff, it's really not that, because you can have Quicken and Fairway and 73 other lenders, or you can have UWM and 73 other lenders. It's not like you're limited by choosing sides, but the goal of UWM was they feel like Quicken, who has a humongous retail presence, is once the broker sends them the business, they've got all the customer information, and they're, marketing directly to clients and trying to like push the mortgage broker out of the equation. And so they were telling brokers, we want to protect you. We don't want to feed this machine that's trying to put you out of business. Whether you believe that or not, I kind of equate it to Zillow. And real estate agents forever and ever and ever have known like, hey, Zillow is doing tons of stuff to take your job away. And I went to a conference recently where this guy was given all these points, Zillow with their instant offers and with some of the stuff that they're doing to try to make it streamlined for consumers. They're doing some cool stuff, dude. They're doing like, hey, is it a hassle to sell your house and then buy forward? Okay, we'll buy your current house and we'll close that within 5 days. So you can buy non-contingent buying forward. That's a pain point that clients, like, it's a good product, right? Like, clients are going to like that. But if you're a real estate agent and you're paying Zillow every single month, you're funding something that is like directly competing with you. And so United Wholesale said, we don't want to do that. We want the broker to thrive. And, some people will say that it wasn't that. It was like a competition thing and they want to beat Quicken because they're rivals and all that other stuff. I'm a believer that they did it for the right reasons. And for most people, with everything that UWM offers, 95% of the people made a fairly easy choice, but still, there's people that came up with addendums and kind of altered the agreement because they didn't want to be told like, hey, here's how you run your business. But I think it was done from,
I think that's more of where I stand with it is I don't disagree with anything that you said. It's more of the approach of like telling somebody else, I think, what they can and can't do starts to become like, I don't know, it just has this very weird feel to it. That I don't know that I could ever communicate that to somebody and be like,
right,
hey, I'm going to tell you how to do this because you don't know for yourself how to do it.
right.
And so I understand where he's coming from. It's just a very volatile message.
I agree, and it was funny because I talked to the guys at Housing Wire who, like, every once in a while I'll chat with them and they're doing an article or something, and he made a really good point, and he was like, listen, like, the people that are faithful UWM, me one of them, like, love what they're doing, really believe in them, like, they're going to be faithful UWM no matter what. So, like, with this coming out, when you had people that were maybe on the fence, or some people like, I love Quicken, great technology, I love UWM too, like, is it going to like kind of rub them the wrong way and push them? Is this going to do more harm than good? I guess we'll wait and see. Yeah. But, I think you're right too. And I think that, like, in today's current environment where, like, weird stuff's going on, we've got COVID, we've got stay-at-home orders, we've got, like, things happening where people are like, I don't want to be told what to do. So I totally get the side that is saying, like, no, man, like, I don't want to be told how to run my business. I became a broker, to have a choice to send my business wherever I wanted. So I see both sides, but I still wear my UWM socks all the time.
I'll say, even if it's the right decision, it puts you in like a weird position of like, oh, well, I didn't feel like our company doesn't use like we're signed up with Quicken, but we've never sent a loan to Quicken. We're not signed up with Fairway, I believe, and we've never sent a loan to either of them. But it just puts you in like, really, like you're gonna. It just feels very strange.
Yeah.
But I get it. I get where it's coming from. It'll be interesting to see long term how it plays out, because I feel like some of the numbers or some of the information that we've been hearing around it is maybe not 100% true, because you hear a lot on both sides telling very different narratives,
Right.
And that's been the case for a long time with this Quicken UWM rivalry. So it's going to be very, very interesting to see. But I definitely am more on the broker UWM side, but interested in both perspectives as well.
Right. Yeah. All right. Somebody else was wondering that, so I'm glad we touched on it, and I won't. Catherine's other favorite, Kyle.
Hey, Catherine.
Catherine G's the best. I think she's seen every video that I've had come out, and so
I love it.
Good to have you here, Catherine. AJ, hopefully you're subscribed to Win the House You Love. AJ's a client of mine out here in California.
Oh, hey AJ. Well, thank you.
Do you view
rock? I picked up some paint. I think I'm going to paint my office.
Is that what you're doing tonight?
Yep. Well, I'm not going to paint tonight. I just want to pick up some a little bit. I was a little antsy.
What else would you do on your birthday?
Hung out with my family a little bit, and that was about it. Nothing too crazy. It's hard to do a lot with COVID going on. My parents both have COVID as well, so that makes it a little bit interesting. I don't know, like I felt like everything was kind of slowing down a little bit. And then now I'm seeing a lot of people around me who now are getting COVID, where before it was like, they're kind of removed from me, and now I'm seeing a lot more immediate people and friends have COVID, and I'm starting to feel like, oh my gosh,
that's interesting.
Do I need to pull back on? I'm trying to be safe as well, but
yeah,
do I need to pull back even more?
I know it's like a weird time too, because like you go out and you're like, nobody has like a branding on their arm, or like, I've been vaccinated, but some people are like, I've been vaccinated, I'm cool, I'm out, and they're doing their thing. And then, I definitely see, where was I at? We went to Vegas last weekend, and it was like, you got to wear masks in the casino, you got to wear masks in the airport and stuff. But like, once you're kind of out and about, me and my wife looked around like, holy crap, like there is a ton of people. Like this is not social distancing right here.
Yeah.
And we kind of asked each other, like, is COVID over? Is it over now?
It's hard to social distance once you're like 2-3 drinks in. It doesn't become much distancing anymore.
Right.
What is this question? It's from Clayton.
Yeah. Do you view Rocket Quicken as a threat to mortgage brokers? What do you think?
I don't think immediately, but I think long term. And I don't know that I would go as far as like threat. Language, I feel like it's more of it's like you mentioned, very similar to Zillow, where Zillow came in and they were like, hey, we're this really helpful thing for real estate agents. And then Zillow slowly kind of worked their way into how can we flip the model and basically cut real estate agents out. And so I think something similar could be happening with Quicken, not on the same scale though, because, Quicken is, in my mind, not going to get to the point of being like the one main lender. There's still going to be thousands of lenders thousands is probably too much, isn't it? Hundreds of lenders that exist. So I don't think we're going to see it at that scale necessarily, because like Zillow is a home search site that anybody can go to. Getting a loan requires a lot more information and a much longer process and a much smaller group of people. So I don't think we're going to see that kind of like massive national spread that Zillow had. So I don't know it's necessarily like a threat, but definitely strong competition for the broker space. I just don't think with like how we're seeing trends with how people just want to buy, not just homes, but anything in general, I doubt we're going to see people gravitating towards a model like a big direct lender, because most of these companies, and I can't really speak for Quicken, I've never gone through their loan process, but most of the time these bigger lenders tend to have staff who aren't as well trained, or they're trained but they don't have a lot of experience actually handling problems that come in, and the nature of these business models are really just high turnover. It's what can we get in the door and out, kind of establishing almost like a factory of sorts with a loan. but unfortunately there's no like cost savings that's happening there, because to get the word out about this massive factory about loans, we have to do Super Bowl ads and all these commercials and develop applications. And I think that people more and more want individuals who can help advise them through the process, because getting a loan is not just it's not a commodity, right? I can't go take it off the shelf and apply it to me. It's something that's very unique to my situation. And I think people are recognizing that more and more, about there's a way that I can structure my debt, not just my mortgage, but also all the other debt that I have with my mortgage, along with the asset that's my house. And the way that I set that up can change my financial future by tens of thousands, if not hundreds of thousands of dollars. And making the right or the wrong choice can ultimately cost me a lot of money or save me a lot of money.
Yeah. And that's the thing. That's the thing too, is that I warn people about, nice guy, but he worked at Chick-fil-A 6 months ago. And now he's working in a call center, whether it's, Better, AmeriSave, Quicken, wherever it is, the very rock bottom lowest rate with the wrong strategy is more expensive. I butcher this all the time, than a competitive rate with the right strategy. That's the Barry Habib certified mortgage advisor quote. But to your point too, like Quicken spends so much money on advertising that I'll get a loan estimate from Quicken. I'm like, holy crap, you're working with a subpar advisor, call center type person, no offense, but that's who they are. And you're paying more for this rate. You're paying a higher rate or higher cost, or sometimes both. In that sense, it's like, do not trust your largest purchase of your life to somebody like that. But one thing I will say, like in their defense, is that they've got great technology. And I think that anybody in any space, real estate, mortgage, whatever it is, when you have the data and you have great technology, like you can be a disruptor. Whether or not they're going to be, I guess time will tell. But already, I think Quicken has crazy market share. Like 10% of loans are written through Quicken. So, Clayton was admittedly on here doing some market research because he owns Rocket. They're a good company in a lot of ways, and they've obviously, since their 10% market share, done enough stuff right. And the messaging, whether it's true or not, about like one-click mortgage, it's certainly working for that 10% of people that are getting loans.
I think the main problem is because like what we're talking about is like the advising piece. There's also the product beneath it, right? So there's the advice, but then there's also like, is the loan cheaper? Which one's the cheapest loan? Outside of the advice, the hard part is like brokers, I think, have gravitated towards the advisor model, mainly because, you and I don't have marketing budgets to go. We certainly can't do Super Bowl ads. Even local marketing is expensive for, individual local broker shops. And so we go more with the referral advisor base type of business model. I just don't think someone like Quicken invests in that. They're more interested in like what's the transactional type of model. But even if we look at below that on like the product level, which one has the better option? I really think it just comes down to like shop with a broker, shop with someone like Quicken. The hard part is it's difficult for people who have never got a loan in their life to make the decision on which is the better one. How do I set these up? What are the options that I have with these? And I think that's the difficult piece. Is it'd almost be nice if there was like an independent advisor who could help you through that process. But of course that would cost money, and that's gonna be difficult to get somebody to do. But
and I think in closing, even though like I realize, is there weird feedback on my side?
There's a little crackling. I'm not sure what that was.
Let me try. I grew up in the 80s, so like you blow on it and then it gets better.
It's got to work after that.
Yeah. Yeah, that's so weird. It just started doing it on my side. But what I was going to say is that, what was I saying? Lost my train of thought. What the heck is that? Could it be my headphones or could it be something else?
I don't know. I hear a little bit of crackling. It's not too bad though.
It sounds like somebody's like typing. Just me and who else is in here? Who's in the back room making all the noise? All right, I'm gonna power through it and try not to lose my train of thought. But I think that God, it was something to do with Rocket. I think.
You started in closing.
Yeah. So I said with great technology, doing some stuff right, 10% market share and stuff. they could be a threat. They could, increase that market share. But ultimately, just like financial advising, no matter how much technology comes out, some people want to sit in front of a high level advisor who has done that job for 30 years and can help them plan things and really put together a plan versus just like 2 clicks mortgage. I mean, that's their messaging, and that's what they're kind of counting on, is that people are going to be cool with like 2 clicks mortgage. I don't know how many people are going to want to get a mortgage that way.
Yeah.
It's driving me freaking crazy, dude.
Maybe it's just like a wire or something.
Yeah, that's what I was thinking. It could be like.
Is there a wire moving?
It's like nothing changed.
Huh. Is the mic even coming in through there, or is it coming in through your headphones?
I'm getting sound through my headphones.
Do you know if the mic's coming through is that a Yeti?
Yeah. Let me see. Cam, mic, audio. Microphone, Yeti. Speakers, Yeti. Echo cancellation, stereo audio.
Man, I love the tech problems that are impossible to figure out.
I know, and I'm gonna laugh.
That'll make me more frustrated.
Jeff liked the Nintendo reference. I've got a Nintendo up. It's before Kyle's time. Kyle turned 25 today, so he doesn't remember Nintendo.
We had a Nintendo. I remember blowing on the what do you call
like
it?
The cartridge?
Cartridge. Yeah. To see if it would. Although I don't think we ever did it to fix anything. We just did it because it was made a fun noise.
Yeah,
like blowing it and put it
like a harmonica, big harmonica. Yeah. This is a popular one. I feel like I've gotten so many questions on my channel about self-employed borrowers and deposits and stuff. I'm guessing, Charles, that your question is, what are they looking at for self-employed deposits or withdrawals? You're probably talking about when we ask for bank statements and a P&L, to show what is happening in 2021. Is that coming through on your side? That click clack?
Yeah, a little bit.
What could it be, dude?
There's
got to be some tech. There's got to be some tech people on the thing. But this self-employed question is a common one, Charles. And if I'm correct in assuming that you're talking about what are we looking for on those bank statements you provide with your P&L, they just want to see if your P&L shows that you've got $32,000 in net income for your business for 2021, and then you've only got $4,400 in total deposits for these first 3 months. Those things don't jive. And so they want to know that your business is operating, it's healthy, and that it somewhat aligns with your P&L. So if you've got $34,000 in deposits in January, February, and March, and your P&L says, in that area, the lender's going to be fine with it. If they don't jive, what I've seen is the lender then asks for an audited P&L. Then you got to go to a CPA and get a P&L that's like, a little bit more official. And so that's what I've seen. You know what question I get a lot too, Kyle, is like people are asking, well, what about if I withdraw, or what about if I pay a line that I have? And I haven't really seen them, underwriters by them, like have any issues with that. What have you seen?
Yeah, as far as the business bank statements, are you talking about like business bank statements when looking at matching those with the P&L, or are you talking about the personal statements?
I think he was probably talking about business bank statements, but I'm not sure. Just deposits or withdrawals is what he said.
For the most part, like the lender's only looking at the bank statements to match up. Basically, they want all the documents they see to match up. It's almost like I just had to get my license renewed, and so the BMV was like, I need you to show 3 forms of your address, 2 forms of your social, 9 forms of your name. Like you have to validate all these different forms. And it's the same thing for income. So for somebody on like a W-2 income, they want normally tax returns, W-2s, and pay stubs. Well, self-employed people don't have 2 of those things. So they want the tax returns. What else are they going to get to validate the other pieces of information? Because they all say that they should say the same thing, right? They just want to see it in 3 different forms to prove that it's true. There's a higher likelihood or less likelihood of fraud if they see that all 3 are true. So they're going to look at the tax returns. They're going to look at a P&L that you prepared. And then also they want to back that up with the bank statements. So for the most part, they don't really care about what you're spending the money on, where the money's coming from in. With the business bank statements, they're mainly interested in like, do these numbers actually match up with the P&L? Or on your P&L, did you maybe fib a little bit and we added an extra bit of income because we thought it would help us on the loan, which I've seen people do sometimes. And then the underwriter says, yeah, that's not the case. You said you made, like Matt said, you said you made, $6,000 a month on your P&L, but your bank statement says 4. So which one of these is true? We need to go off with the 4 because that's the correct one. Now we need an updated P&L. We need all these numbers to match. So that's mainly what they're interested in. They're not actually, they don't really care. They're not going to go line by line and be like, I saw that your business spent, this amount of money at Chipotle. Tell us about how your Chipotle meal was and what kind of rating are you going to give it. They're not super interested in that kind of stuff. Although I am. I want to know how you feel about Chipotle personally.
Dude, I love Chipotle so much. It tastes so good, but every time I eat it, I just feel terrible for like a day.
I think this is my theory. I think it's the rice.
You think it's rice?
Well, you get this whole bowl of it's just so much fiber, and I think that's what does it.
All right. I'm going riceless bowl next time. We'll see how it turns out. I'll report back. Everybody
well, then you
interested?
won't like Chipotle anymore, I think.
I like all the other stuff. I like the black beans and the.
Now, do you get the same exact thing at Chipotle every single time?
I probably get something different like every time. I'm the type of guy that just variety is the spice of life.
What do you change? So you change like the protein, or you change it all?
I usually just change the protein, where it's like sometimes it's a barbacoa day, sometimes it's chicken day, but then sometimes I'm like, oh, I'm feeling like some, the onions and peppers, and sometimes like, no, sometimes I'm feeling black beans, but it's always both the hot salsa and the pico de gallo. You got to have both. And if you're going to do it, you got to have cheese and sour cream. Even if you're trying to, I'm doing something right now called 75 Hard. Have you heard of that?
Huh.
It's like 75 days of strict diet, no cheat days. So I'm doing 2,200 clean calories, 2 45-minute workouts. One's got to be outside, a gallon of water. I've been crushing it today. This one's like almost done.
Nice.
And 10 pages of a physical book and a progress pic. And I started last Monday. Yeah, it's meant to like test you in like, can you stay consistent with something that's hard? Because it's like 2 workouts a day is hard when you're, a family man, you got a thriving business, you're trying to coach baseball, you're trying to be a good husband, be a good father, all that other stuff. So it's definitely been hard. Like I woke up the crack of dawn, got my first one in, came to worked till about 2:45ish, went for a 5-mile run, showered in my office, came back doing this. So it's certainly not easy, but like with that discipline, I'm feeling good, dude. Like after 75 days, I started at 212, and I think I'll probably be like 190, which is
so you've already done it for 75 days?
No, I'm only on day 8. So
day 8, okay.
Yeah, so about 2 more months and some change down the road.
Man,
you'll see.
I don't think I would get past day 2.
I was doing it with a buddy of mine who I text today just to be like, I'm feeling good. He's like, I cheated this weekend starting over today. And so we'll see, but
I think that would be me. Do you have to restart the whole 75, or are you?
I'm sure. Yeah. I mean, it's one of those things where it's free. Like you don't even have to pay anything or like join anything. It's just,
okay.
And if you like Google 75 Hard, you can find it. So, tell me your secrets. Are they talking about Chipotle?
Chipotle secrets?
Yeah, I don't know. Do you own any Bitcoin? I've got 0.2. I'll tell a fun, quick story about Bitcoin. In 2017, I had a bunch of guys in my office that were like super crypto freaks and like all these altcoins and doing a bunch of crazy stuff. And I had a brilliant idea where I'm like, I don't want all the like crazy wild stuff. I just want the main Bitcoin. And so I had, I think it was 2 Bitcoin. And I still remember I went to my brother-in-law's 40th birthday in Tahoe, and it was like December was a super crazy month where it went up like crazy. And I think it went from like in the 5,000-ish range to 18,000 range on that bull
Wow.
run. And then it came down, like crashed hard, and it was back to like where I bought it at, like 4,500 a coin. And I sold it in early 2018. If that doesn't line up with the valuation of Bitcoin 2018, it was somewhere.
And
I
what's
swore
it
it
at
was like,
now?
now it's like at 57 or
Oh my
58,000.
gosh. Yeah.
So yeah, I would have had 115,000 of Bitcoin. Key like would have, don't. I own a little bit of Bitcoin, like a fourth of one, and I own 6.6 Ethereum. But Ethereum's up to like $2,000 a piece. So that Ethereum's worth like 15 grand. Probably 15 grand in each.
Okay. Yeah,
And now
I don't own any cryptocurrency. I've been wanting to look into it a little bit more. I don't want to just throw money into something that I hear other people talking about, because normally, yeah, what's the saying? Like, when other people are talking about it, that's normally not the good time to buy it.
right.
It's more, there's a more eloquent version of that. I need to do some research on it, but after going through that CMA course, and doing some more of the technical analysis, I've been like, man, this would be really interesting to dig into a little bit. It just is so, I haven't done any research on it, so it kind of confounds me on like, what in the world is this thing and how is it working?
Right. Yeah, I have a very basic knowledge of it. Have you heard about NFTs?
Yeah.
Non-fungible tokens?
Yeah.
That's another thing that's like, man, like it makes me like my head hurt a little bit, like trying to understand it. But some of the stuff I've seen where I'm like, that's a cool idea, where you could be like an artist, like you're like Bon Jovi, and you sell some non-fungible token that has in it, like you sell 6 of them, and maybe it's like you sign a guitar, or maybe you don't need to do that because it doesn't have to be anything physical. But it's like it's a token where it's like a signed poster that you have, and like you can just brag to your friends, I've got one of 6. Yeah. But then also you get to go to a live concert once a year as part of that, like ownership of that token. And then the crazy part about it, whether it's art, whatever it is, I think mostly it's art right now, is if you are the artist that sells it, and I sell it to Kyle buys it for 20 grand, and he gets to go to a concert a year for the rest of his life, and he has the bragging rights of this token. If you sell it for 50 grand, the original artist who sold it to you, I get a cut off that next sale. And every time it sells down the road, like imagine if you were Van Gogh and every time your friggin' painting sold, you got a 5% cut on that resale.
Interesting.
And it's all like, you can't sell it and not have it be public because it's all like on this public blockchain.
Yeah.
So it's like interesting stuff, dude. I mean, probably
it sounds like we're going to get into art. Is that what you're saying?
Yeah. Or like
into art or concerts.
I don't know.
You choose.
I got a mortgage business. I got a family. I've got, a book I want to write. I've got a YouTube channel. I've got all kinds of stuff. I got nothing but time, man. Let's take on some more hobbies. This one was interesting. I didn't want to skip over this question because Chad made a comment, which I think is good to chat about. Quicken Better. Better.com when they first came out was what'd I do? They're a big online lender, and they're using technology and direct to consumer. So they're similar to Quicken. I don't know if they've improved their systems, their technology, their product, but in the very beginning, for sure, I got a lot of, bad reviews and bad stuff from them. But, Chad's saying that you're a lot of my fellows, I'm guessing fellow entrepreneurs, fellow self-employed, maybe is what you're saying.
Yeah. It's no secret that the broker world and I mean a few other lending types are not great in the jumbo space. Like that's not a secret. And I think if you talk with a broker, if you want to know if they're like going to be honest with you, is asking them about jumbo loans. Like, hey, are you like, tell me where you're at with jumbo loans? Like, and you'll see if somebody's going to be honest with you about that. Mainly, and my theory behind, I think, why some of these companies choose to be more aggressive with them. So someone like Quicken or Better is that like, if we're looking at the cost of a loan, the transactional cost of a loan, each loan tends to have a pretty fixed cost with it. Just based on like even staffing, all the people needed to close a loan, which is more than just a loan officer. There's a lot of people involved in helping that loan go from closing to all the way sold on the secondary market. And all those people need to be paid along the way. And so that cost is going to remain very similar across the board, fixed cost wise. And so it makes more sense to spend our time and energy on these, higher value types of loans for these bigger companies. And so they often they're kind of almost like racing to the bottom on these jumbo loans. They're carving out their own space in it, where it's hard for smaller shops or smaller lenders to be able to have the operational capacity to actually close those types of loans.
Right.
Is that kind of similar to what you're seeing as well?
Yeah, and I think that I had a lot of excitement around this 10% down jumbo that UWM's doing, because that's a product that's probably really competitive versus the few others that do offer 10% down jumbo. But to your point, there's certainly places where you can get smoking deals on jumbo. Kyle went dark. And one thing I've always told people is, if you've got deposits at a big bank, I've talked to bank friends that are loan officers, and Chase, for instance, if you've got $500,000 sitting in there in deposits, they want you to have your mortgage there, because once you have your mortgage there, you're more likely to have your investment account stay there. You're more than likely to have your business checking open there. You're more than likely to have all this other, all these other products that they want, because they make money off of that. So Chase was writing this loan. I asked my buddy, I'm like, how in the world do they write it at this crazy interest rate that's so much better? And he told me, he's like, they're going to lose $17,000 on this jumbo loan. But that's how important this client is to him, because the client's got 6-7 figures in deposits, and over the course of the next 20 years, which, I mean, I talked to someone recently that, I don't know if they were showing statistics or it was just a guess, but like, having a mortgage at a bank makes you so much more prone to open other accounts. So for the right clients, if you're getting $130,000 FHA loan, I'm sorry, they're not going to, bend over backwards to give you a smoking deal, because they want you to keep your $30 in deposits in their bank. But if you're a client with a tons of money on deposit, that's why banks are open about it. They're like, if you bring 250 over, we'll give you a quarter off your rate. I see that stuff all the time. So in that case, banks can be super competitive in the jumbo world.
Yeah, I've lost deals to people who, like, they've come in with a quote, and this was like a year ago, so these rates are not going to match up with today. Or they would come up with a quote of like 4% with some bank that they had, and then we'd come in and be like 3.5, and like huge differences. And they would literally tell me, yeah, but we'd rather just the ease of it staying at our bank. I'm like, oh my gosh, there's no way that I can ever, like, if we're coming with that mindset, there's no way that I can ever help you understand how much better the 0.5% in difference is going to be. But yeah, I think you're completely right. People just like it, that convenience, to all be in one place. And some people are willing to pay the premium for it to be all in one spot. With that, my battery is about to die. But I don't want to hijack your stream for too long. But it's been
no, it was cool having you, man. I think like you coming on definitely added value to it, and it's cool. I got to tell you happy birthday. Not just on Facebook, but here face to face, man. I appreciate you. We're going to be live in a couple weeks, right, with some of my title folks on your channel. So looking forward to that, dude. So yeah, take care. I'll remove you. I'll see if I still get crackling. If not, then it's all on you, man, and your dying cell phone battery. Cool, man. Happy birthday, dude. Thanks for jumping on.
Well, thank you. I appreciate it. Have a good night.
All right. You too, brother. All right. Cool, man. That was fun. That was good having Kyle Seagraves, Win the House You Love. If you're not subscribed to that guy has got some of the best information out, and it's apparent that he's one of the best on YouTube, because he's got 60,000 subscribers and millions of views. He's got the calmest voice on YouTube. But I think, yeah, his phone must have been dying, and something with his internet connection or something was causing the crackling. I'm glad that it wasn't my side. I was blowing on this thing like it was a Nintendo, and I was trying to get Mike Tyson's Punch-Out to work. So yeah, I'll have to call in a favor from Kyle and be like, man, remember that time you came on my stream, you had all that crackling, and then he's got to owe me. I think he's already making good on it though. We're going live on his channel in a couple of weeks. Him having me's cool because I'm a small timer. He's a big timer. So having me on his channel helps me. Judy, is it a good idea to cash out your 401k to buy a house? I feel like I either got this question through YouTube comments or I talked about it with somebody. It really depends. And I'm sure there's like, this is one of those questions where there's going to be, why in the world would you ever think about it? You're a complete idiot, versus like somebody else who's like, of course. Yeah. Like, stock market's been on a crazy run. It's due for a correction. Take that money out, buy a fixed asset like real estate, and then, pay yourself back. I think it depends on how you do it. I would not mind personally doing a 401k loan. There's a lot of 401k companies allow you to do that, and you pay yourself back, then your dollar cost averaging back into your investment. I don't think you should cash it out and forget about it because, you're kind of robbing your future self. But I don't know. I mean, I'm not a humongous fan of 401ks anyway. I love having an asset that I could literally like touch. A house is a real thing. Rents continue to go up. It appreciates over time. You get the debt pay down of your tenants paying down your debt. So, I mean, I love real estate. I love real estate more than money sitting in a 401k, but there's probably some people that think it's a terrible idea. And so it depends on who you ask. Me personally, I don't think it's that terrible of an idea, depending on your whole financial picture. And that's the big thing about any mortgage advice, really, is it really all depends on a number of different things. Can I put only 3% down? Would rather have cash flow for business? Sure. If you are buying conventional and you haven't owned a property in the last 3 years, you're considered a first-time buyer, and you can put 3% down. 3.5% is FHA. And if you've got great credit, you probably want to do the 3% down conventional. It's going to be better looking than FHA deal. We didn't get to ask this to Kyle, but we'll ask him, Catherine, next time we see him, or pop him a message over there. He's got the Calm Planner coming out. What happens if you have a great credit score right before you close, a medical collection appears? Usually medical collections don't really hurt your credit. I think the credit algorithm is basically just told medical collections that half of them are wrong. And so I've seen so many credit reports that have 2 medical collections and they're 765. So I wouldn't sweat it. And it's very unlikely that like a soft pull that a lender does before closing is going to have that medical collection show up. So I wouldn't worry about it. I don't think it would really affect your credit score. Yep, it's Kyle's birthday. He's 25. Dude is wise beyond his years, but I'm jealous of his youth. I'm 40. I remember being 25, and I was far less smart than Kyle, far less along in this life journey. He's doing good work. Thanks. I appreciate the support, man. Crackling gone. Yep, it was all Kyle. Friggin' Seagraves, man, coming on just crackling. It was weird. It didn't happen at first, so it must have been the internet connection. How do you invest besides real estate being self-employed? I'm able to, since I'm an S corp, create my own 401k. So MG Real Estate Group Incorporated has a 401k that I fund. My wife works in the business with me, so she gets paid and she funds her 401k. Then we've got real estate investments. Then we've got some stock market stuff. I'm not Meet Kevin, so I'm not holding 7 figures, but I have, for the last couple of years at least, put X number of dollars into the stock market month after month, and tried to be of the mindset of it's long-term investment. So I'm not doing any type of trading. I'm not doing anything that's short-term. It's like, I believe in Tesla. and smartly, I believed him in 2019. So I bought most of the Tesla I hold in 2019. I believe in, what are the other companies that we own? I'm trying to remember. What's that one? Basically, like I love Chamath, who is, through SPACs, making some of these companies go public, like Clover. Clover's probably a loser, but I like them and their business models, like, technology and medicine. What's IPOE? That's SoFi, Redfin, because I've used it as a consumer. Like, I just think their app is really neat for looking at real estate. What else do we own? Some stock stuff. I think that's it. Real estate heavy, because I love real estate. So me and my wife own 11 doors, and then stocks, 401k, and that's about it. Why do most self-employed get denied? Well, I wouldn't say that most self-employed get denied, Miguel, but what I will say is that what you make in your heart doesn't always translate to what you make on your tax return. And more often than not, if you're self-employed and you've got a successful business that pays the bills, but you've also got a really creative and smart and aggressive CPA, they're taking the tax advantages, the write-offs that are probably legal, but it takes your $180,000, $250,000 income, gross, down to like a $26,000 net. And maybe it's all legit, but that $26,000 a year net is not enough to be approved for any sizable mortgage. And so that's where self-employed folks get into trouble. Thank you, Lori. I swear it's like this Streamlabs stream or something, because this is like super wrinkly, except for that on this, I look like I work for, see that too? Like these wrinkles. My wife loves me. It's all that matters. Meet Kevin is a must watch for me. I really like Meet Kevin. I wish, because I'm a huge real estate guy and I love real estate, that he's still focused on real estate. Because stocks are cool, but geez Louise, man, I don't need market open, market close, all that market stuff every single day. I'd love to hear about some real estate stuff and some other things he's got going on. But I can't hate. The guy's got just one, insane work ethic, 8 videos a day, and 2, really good analysis of the stock market and the stuff that he's doing. So yeah, I'm a big fan too. I'm with you on that one. Thanks for the guidance you're putting out for home buyers. Any guidance on how to compare loan estimates beyond the rate to decide on a lender? Well, here's what I will do for you. This is an amazing question. Share screen. Okay. I'm going to pull this up and see if, can you guys see that? Let's zoom in. Control zoom. Hopefully you can see this, because this is a loan estimate. And here's what you want to do for comparing loan estimates. It's really, really easy. Everybody, if it's a true loan estimate like this, great, because you're going to get to compare apples to apples. Box A is literally the only box you have to look at if you're a consumer and you're trying to compare loan estimates, because box B, credit report, appraisal, tax, like no matter who you work with, that's the same. All this title stuff, no matter who you work with, that's all the same. The recording, transfer taxes, prepaying your homeowner's insurance and all this other stuff. I don't know if this is too small, but like this side over here, all that stuff is going to be the same no matter who you work with. And here's the problem. Some lenders are going to say, oh, I'm withholding 4 months of homeowners and 3 months of property taxes, when based on when the loan's closing, they've got to hold 6 and 7, but they do that to make it look better, right? And then you're like, oh, total closing cost is $5,600 with Matt, but it's only $4,900 with somebody else. Well, if they cheat this by $1,500, But in box A, they've got more charges there, then they're worse, right? And so here's my easy advice. I'll zoom back out. You look at your rate, 2.66%. Granted, this is from January. I'm not offering this. I'm sorry. This is back in January. Box A, there's no points here. If you were paying for this rate, if there was costs for it, it would be right across from percent of loan amount points. It'd be right there. There's no points. This was a loan that was no points being charged, no credit either. 1055 is the flat fee from United Wholesale Mortgage. And then there might be a third line that says like broker fee, processing, something else. The loans that I write in general don't have a processing fee. This 1055 comes directly from the lender. And then depending, if you want to pay points and buy it down, you can, but it's not usually going to be advised unless it's a shorter break even. So that's the gist of it, Arpit. And I hope that helps, because rate and cost in box A are really the only two things you got to look at. And I think I made a video on that, like comparing loans apples to apples. All this other stuff, don't even pay attention to it, because here it's like 7 days of interest, because we're guesstimating we're going to close on the 23rd or 24th of the month. Well, if another company puts 20 days or another company puts 1 day, I've seen stuff, and I've seen stuff from lenders that are like, this is 1 day, these are 3 months apiece. They're really trying to thin out this side, because then somebody looks at total closing costs and they think, oh my gosh, this is ridiculous. But this box A is the only lender controlled one. And then on box D, like adding A, B, and C is the total cost of those three. So hopefully that was helpful. Now, where do I stop share? How'd you get your start? 2013, I was working for the state of California. I did not necessarily enjoy it. It wasn't challenging. And a buddy of mine was like, hey, you'd be good at mortgage. You're good with people. You're good with math. You don't mind working hard. And the rest is really history. And since 2013, I've done the same thing. Add as much value as possible. Let the deals come in. And I'll tell you, last year was year 7. This is what busting butt and providing value does. Number 1 at my company. There you go. That's a humble brag. 84 million-ish, 248 units. All right. Since you asked, right? If I'm not going to promote myself, who will? What's the average mortgage you see? I don't know if you're talking about loan amount or type, but I think the vast majority of people that get referred to me or people that I work with, if it's a primary purchase, I'm dealing with people doing a conventional loan with 5 or 10% down. And that's the first time buyer demographic that's doing that. Or I'm dealing with somebody who sold a previous house. They're using proceeds to put 20% down or 25% down on their next house. But I think that probably if you were to look at like my most common loan type, it's probably 5% down conventional. And I've made videos on it where with mortgage insurance coming down, getting cheaper, putting 5% versus 10, 15, or 20 is becoming more common and really makes more sense. I'll share something else with you guys. And this is an old one, so forgive me if the rates aren't accurate, and I'm not offering rates. I am just showing an old example back from the 20th of January. Oh, it's really hard to see, huh? How do you zoom in? Oh, it's down here. So too much zoom in. Just to kind of on that point of there's 5%, there's 10%, there's 15%. This mortgage insurance, $87, then $64, then $35. If somebody's buying for $500 and the difference between 26 and 2,500 isn't a big deal, then it's like I'd put 5% down versus 10. And you'll see 36 versus 61, right? An extra 25,000 sitting in the bank. to a lot of people, especially if they're a first-time buyer, is more important than that $125 a month, because that's the savings, $125 a month. And so, I don't know, just my thoughts, my random thoughts. What's your opinion on buying a home that may potentially need its roof replaced soon? I'd want a discount for the cost of that roof. I say that and then I remember what kind of market we're in, where it's like, you'll buy this house, you'll buy it in this condition, you'll pay us what we want, and you'll smile. So I guess you got that working against you, right? Whatever the seller is willing to do, maybe you've got a great realtor that's able to communicate that to the seller. Hey, listen, and it's going to depend on how much competition there is for the house, first and foremost, because what you'll find in this market, if the house doesn't have any other flaws, but it's got a roof that's going to cost $14,000 to repair 3 years from now, someone's willing to pay as much as you or more, doesn't care about the roof, is going to absorb that cost. And so you might not win the bid. But if you're offering on a house, Linda, that's been on the market for 25 days, they've got no offers, come in, have your realtor explain that to the list side. Hey, we did an inspection and this roof is going to be, need to be replaced in 3 years. So my client is going to want an $8,000 discount, not the whole 14 that's going to cost, because it's got a few years left on it, but an $8,000 discount. And maybe you get it, maybe you don't. But that's what I would at least try for if I were you. Who pays the realtor when I buy a home? The list side, the seller. So I'm selling my house to you, Barry. I sign a listing agreement with my realtor and I say, realtor, I agree to pay you 6% to sell my house. 3% of that is going to go to the buying agent and 3% of that goes to the listing agent that lists it and sells it. So it's like a split between the two, but it's 100% from the seller. The seller sells for $500,000. And so 3% on each side is 15. And so the agent who you work with, who brings the deal in, gets 15,000. The listing agent who sells it, they also get 15,000, but it's paid by the seller. 500 grand minus those 30,000 in commissions, minus some title fees, minus what I owe on my loan when I leave. That's what I'm going to net. So cost you nothing, which is the reason why you want to find the very best realtor. The very best realtor is the realtor that knows the area you're buying in. They're busy enough where they're not desperate to sell you a house. I'll tell you, there's more active realtors than there are homes. That lets you know that 90% of the realtors are no good. 10% of them do all the business. And the ones that do a lot of business are going to talk to you, Barry, and say, Barry, yeah, this house walkthrough, it's cool. I think it fits some of the stuff you're looking for, but that train going through the backyard, it's going to drive you crazy. I don't think that's a winner. And this one, I've got great realtors I've worked with that will point out the flaws. And sometimes it's like, no, it's okay. I still want to buy this house. But a lot of times like, oh, I didn't think about that. I'm emotional about the house as I'm walking through it, but you're, somebody who can just look at it through a different lens and tell me. So that's the realtor you're looking for. Someone who's not starving to death. Thanks for holding the live video chat. I'm just glad people are here. I started doing it. I'm going to do it every Monday at 5 p.m. And when I first started, I was really thankful to have one or two people join. And tonight we had 30 plus at any given time asking questions. And so I'm just going to keep rocking, man, until questions start flooding in. Maybe 2 hour 15 or something. I'll cut it off because I want to make sure I get home in time to tell my boys good night and see my lovely wife. Any updates on changes to investment mortgages? Have you seen where investment rates are right now? You know what? For joining, let's tell you exactly what they are. Because I'll tell you what, this is what I'm going to tell you on investment property loans. Some lenders who didn't do a ton in the past are not having an issue with the fact that only 7% of the mortgages that they sell to Fannie and Freddie can be investment second homes. For example, United Wholesale Mortgage didn't do a ton of investment properties in the past. I would send all my investment property stuff to Home Point. Home Point was super sharp on price, which meant they got a lot of business, which means they've got a ton of investment in second homes. And now Fannie and Freddie is like max 7%. If they're sitting on 12 or 13% of the loans that they hold, they've got to jack prices through the roof. And They did. United Wholesale Mortgage, at least for the time being, hasn't had to make what are called LLPAs, loan level price adjustments. So I'm typing in Joey Garessi. You are going to buy an investment property for $400,000 and you're putting 25% down. Just a hot tip for everybody watching. If you're buying an investment property, 25% is the magic number. You can do it with 20%, but you're going to get a lot better terms with 25%. Joey, you seem like a guy who's got a 768 credit score. 5% down, 30-day lock, investment property. This is going to vary state by state. It's going to vary even broker shop to broker shop. Some have different margins. But the par rate that I'm looking at, where you don't pay any points, is 3.6 on that scenario. If you paid a point, you can get it down to 3.25. 3% is like 2.5 points, so I wouldn't recommend that. 3.5 is a fifth of a point, so 650. Gosh, pretty close, right? Yeah, so 3.6, pretty good for an investment property, right? I mean, especially considering the primary stuff is like a 3.1 right now, ish, depending on credit score and down payment and all that stuff. So, yeah, that is that. Cool. Glad that was helpful. Pete, I'm trying to become a mortgage broker. What's the average salary? This is a tough one because it varies widely. And you can work for a bank, you can work for a direct lender, you can work at different outfits where like per loan you get less, but maybe you're fed deals. Where a mortgage broker like me, I might get paid more per deal, but if I don't bring a deal in, me have no deals. So if you Google this question, John, I bet you're going to get like a number like 50,000, and that's like a realtor average too, right? I know plenty of realtors that make 500,000 a year. I know realtors that make $1 million a year. I also know realtors that do 3 deals per year. So those realtors make, probably after paying taxes and paying their broker shop and all that other stuff, 19,000 a year. So it's going to vary widely. If you've got the grit, we'll call it, to stay in it for the long term and put in the work, it's like most things that are commission based, where the ramp up is not something that's going to happen super quick. But after being in it for years and getting to the level where I've got a lot of business coming in, it ain't bad. Average net for self-employed that you see. Well, this is another tough question too. I mean, I've got businesses that are humongous liquor stores or janitorial businesses that have 500, 600, 800,000 net incomes. But what I will tell you, Mel, depending on what part of the country you're in, if you're trying to get a mortgage that is, say, $1,500 a month or $2,000 a month, that you're going to need $5,000 or so per month, depending on how much debt you have as well, to qualify. So you're going to need $60,000 on that net income. If you're Schedule C, I think it's line 31, right? Net income. You can add back some things, depreciation, whatnot. But for the most part, the average isn't necessarily going to matter. It's what you need to qualify for your specific loan. And what'll happen sometimes too is that if you're new to a business, you're like, hey, I only made 63 last year, but this year I made 110. As a self-employed borrower, if you've been in business for less than 5 years, we're going to look at the average of the last 2 years. So year 1 is 63, year 2 is 110. We're going to take the average of those two, 173 divided by 24, $7,200 a month. What lenders will do as well is, like, we're 3 months into 2021, year to date P&L, 2020, 2019, 27-month average. Let's see what that is. If the 3 months of this year is lower than that total 27-month average, maybe we take the lower of the two. That's kind of the state of self-employed loans right now, is that if there's two different things to look at income wise and one's lower than the other, you can bet your bottom dollar that the lender is going to look at the lower of the two. A great realtor isn't pushy and desperate for you to buy. True story. But a good realtor in a market like we're in now is going to tell you straight up, hey, Linda, this property you looked at, you liked it. It's nice. I talked to the listing agent. They've got 14 offers already. They're presenting tomorrow night. It's listed at 385. I know. I read through the lines. I talked to the realtor. If we're thinking about offering any less than 430, we've got no shot. That's something that I talked to clients who told me after the fact, I wish my realtor would have been more straightforward with me. That's not necessarily pushy. That's just saying this is the state of the market. I'm trying to put you in a position to get this house if you really want it. If you're uncomfortable with submitting an offer that's above ask like that, then we won't write it. But that's what it's going to take to get this home. Average interest rate you're seeing. What type of loan? How much down? What be the credit score? My average is in the low threes for clients that I'm doing loans for, purchase and refinance. So there's that. Vast majority of what I do is conventional. Vast majority of what I do is good credit score. So, take that into account. But I'm looking at stuff that's landing anywhere from 3.05 to 3.15 right now. Not paying points. If people want to pay points to get under 3%, they still can. But that's the short answer to that, Jessica. If you're getting an FHA loan, you could still get sub 3%. If you're VA, you could still get sub 3%. But yeah, it's going to vary by lots of different stuff. When you get a mortgage using a broker, there's an extra fee you have to pay. The opposite of extra fee, much less fee using a mortgage broker. As a mortgage broker, I'm sending my loans directly to the wholesale lender. United Wholesale Mortgage, Home Point, Cardinal, Caliber, Sierra Pacific, whoever it is, right? And they charge a flat fee, admin fee, whatever they want to call it, $10.55, $10.95. You work with a direct lender or a bank, they're going to charge processing, underwriting, admin. I've seen it anywhere from $9.95 to some places have it be $2,500-ish or so. So, it's going to be generally faster, easier, cheaper. Use a mortgage broker. That's where I'll end that one. Yeah, that is pretty good, huh, Joey? The funny part is if I looked at that at another lender, I wonder if I can do it without getting too sidetracked or taking too much of my focus away from the stream. I'm going to try to price that at another lender right now, Joey, and see what it looks like, because I think it's in the fours at other lenders. But that's the advantage of working with a broker, right? Is that I'm going to be able to price a number of different lenders, find you the best deal, and just say, hey, I've closed 1,000 loans with United Wholesale Mortgage in the last 4 years. So I know they're going to be quick pricer, 25% down investment. Look at that. I already have it like in my pre-saved. Conventional purchase, 400, 300. This is cool, man. This is already preloaded for me. We'll see how this one pulls up for you. Stand by, everybody. We're pricing something for Joey. Remember that 3.6 that was zero cost, 0 points? It's 1.5 points at this lender. I'm not calling any lenders out, but 4% is their par rate for no points. So it's going to vary. I bet you there's some direct lenders, and I bet you there's some banks that are charging 4.5% on investment property, 25% down. 3.6 is smoking. They're going to get all the loans. Bring them on down. Make sure they're big and they're in California. That's my only two stipulations. Just kidding. They don't got to be big, but I'm only licensed in California. We want to sell, move out of Cali and buy, upgrade out of state, but the market is so hot elsewhere. Yeah, I mean, it's really like nationwide. I talk to people all over the country, and people are, giving me comments from, Massachusetts to New Jersey to Florida to Illinois to Texas, Seattle, Arizona, all over the place. And it seems like it's pretty crazy everywhere. except for that, depending on what part of California you're in, maybe you sell something, a 3.2 that is 500,000 in the market you live in, and a 3.2, albeit crazy bidding wars and, people bidding on it, might bid up from 285 to 310 or 320 in the market you're buying. So who knows? Do lenders care about cash reserves as self-employed? It really depends on the loan type and if you own other rental properties. If you're doing 5% down primary, you don't have other investments, and you've got a cleanish file, I don't really see lenders asking for cash reserves. So you should be fine there. As long as, income checks out and you qualify otherwise, you should be good without needing a bunch of cash reserves. Do you know anything about CalVet loans? Have you done any CalVet loans? No and no. Sorry, Lori. I know that we can broker them, and there's people in my office that do broker them. So if you'd like me to connect you, Matt at mattthemortgageguy.com, I'll do that, because in our internal forums where Answer Home Loans loan officers chat, I've seen the talk of CalVet, and somebody in my office has said, oh yeah, here's how you do it. And rather than try to fumble through it myself, I'm just going to refer it out. You're going to be taken care of. That's all that matters. Why do lenders stretch loans? I earn $120K net and they approved me for $680K. I mean, that is the qualifying criteria that has been set up. And so here's what I do when I pre-approve somebody. I say, hey, Tiff, I usually don't even tell somebody their max pre-approval, right? I tell somebody, if part of the intake is what are you looking to buy, and I tell somebody that, is looking to buy, like say you came to me and said you were trying to buy around 500. I would pre-approve you and I would show you 475, 500, and 525, those three loan options, and then tell you qualify for much more than you want or need. Take a look at this, what payments and total cash to close relative to those price points kind of say to you, and let that dictate where you're going to buy. Because once somebody has that information, you might look at it and go, oh, you know what? 525 versus 500, it's not really that much more, and my budget can handle that. Maybe ask me to see 550. And then you tell your realtor, let's land between 525 and 550. Maybe we're looking at houses that are listed at 500. And that way, it's based on your budget. It has nothing to do with what's the max I qualify for. Because for somebody like you, and I'm guessing that you have very little debt, and that's why your qualification is a little bit higher. Because if you had a high car payment and you had other debts, then you might qualify for less. So you've got perfect credit, whatever down payment you have, and you've got very little debt. So you qualify for a lot. You wouldn't even know you qualified for 680 unless you asked me. I would show you examples of what the mortgage payment and the total cash to close looks like based on what you're trying to buy. A little bit above it, a little bit below it, so you can see and decide, oh, if I buy in this neighborhood, I can buy for 475. Or if I go to the little nicer neighborhood, better school district at 525, and then you decide. And then you communicate that to your realtor, and your realtor finds you a house. Welcome to this. All right. We are here. Welcome. That's not really true. So Eduardo, I'm sorry, about size requirements to get a new owner occupied loan. And so I'm guessing, Eduardo, you've talked to somebody and you say, hey, I've got a 1,600 square foot house that I've owned for 4 years. I want to buy a new house. It's across town and it's only 1,750 square feet. So it's not that big of an upgrade. Maybe it's a 3.2 or a 4.2, just like the one I'm currently in. What a lender is going to ask of you is why. And you can explain it however you'd like to explain it. If you intend to occupy the new one as your primary, I'm moving closer to family. I'm moving to a school district where I want my kids to go to school. I'm moving closer to my job. All these things are legitimate. You could go from a 2,000 square foot house to a 17,000 square foot house if you're moving 5 doors down from your mother-in-law, or you're moving, 5 miles closer to work because you want a lesser commute. That's you. That's fine. I got a new primary in 2017 and I moved very close to my current primary. And my wife didn't like all the freeway noise. And so it was like a like for like house. They were very similar, same neighborhood, and we were moving away from the freeway. And the underwriter was like, hey, you moved from next to the freeway to 5 houses in from the freeway. That's not that much difference. Well, it is. It's a lot quieter. I can tell you that. I've been in that house since 2017. So whatever the reason is, they just have to put a letter of explanation in the file. And you can't do anything ridiculous. Move from a 3,500 square foot mansion to a 400 square foot condo. Like that doesn't sound legit, right? Or I've had people tell me they're moving from a huge single family to 1 unit of a fourplex. Not legit, right? So you've got to have a real legitimate reason. Can you get an FHA loan without credit? FHA will go down to 500 credit score. And at 500, you have to put 10% down. Once you get to 580, you've got to put 3.5% down. If you find, no. Dave Ramsey will be like, you don't need credit. You can get a manual underwrite. 1, very hard to find. 2, when you do find it, terms are terrible. And I don't think you can do an FHA with a manual underwrite. Maybe you can. Here's my advice, Sonny. Even if you could do it without credit, I wouldn't. With FHA, once you get to 580, you put 3.5% down. You're kind of out of the danger zone. 500 to 580, you just shouldn't. Then you get to 640 and you get into a good looking loan as an FHA buyer, maybe 620. But even between 580 and 620, I would much rather have you save more down payment and fix your credit. It's going to be a lot better long-term deal. All right, rant over. Do most people live above their means? Yes. Yes, indeedy, they do. As somebody who looks at finances all day, every day, and back to the point that somebody made about like qualifying for more than you'd ever want, some people, that's what they want to know. What's the max I qualify for? What's the max I can take out on a refinance? They're trying to max everything out. Max out their cars, max out their credit cards, max out their home purchase. It's a slippery slope. Can you get away paying closing costs? I'm guessing that you want to know if you can avoid paying it. There's 2 different ways to do it. Get a seller credit to pay for it or get a lender credit to pay for it. I made a funny video on how lender credit works, and it's not a free gift or it's not like a package I get out of the back where it's like, congratulations, you're a VIP, you get lender credit. 3.1 is no cost, par for this example. I'm not offering rates. NMLS 1088993. 3.5%, I might offer you a 4,500 lender credit. Take a higher rate, you pay more per month, you pay more interest, but you get a lender credit to cover those closing costs. That's how lender credit works. Or you say, hey, seller, I know you wanted $350 for this house. I'll offer you $355. Give me $5,000 in seller credit. And whatever your closing costs are, sometimes between lender fee, title fee, prepaying taxes, prepaying insurance, prepaying interest, all the other stuff that's built in, that could be $6,000, $8,000, $10,000. It all depends on how big of a house you're buying. But that would be a way to get those closing costs covered. In most markets in 2021, good luck. Otherwise known as no friggin' chance. Thanks for coming, Eduardo. That's what I'm trying to do is add value. If you come and you ask questions, I'm answering them. And I answer them the best I can. As a seller, do I need to pay closing costs? There's title fees and whatnot associated with selling a house. And I see it on the net sheet when somebody from title sends that to me, but I'm not an expert in it because it really doesn't pertain to me and my clients. So best real estate investment, the one you make, bro. I mean, you can sit on the sidelines and talk about it, or you can get in the game, you could be about it. That's your best real estate investment. the one you make. I mean, I know people that have made bad investments. Look at my channel for what. Watch this video before investing out of state. Terrible investment. My wife told me I was an idiot, and then she proved it when things went sideways for years on end with the investment in Alabama. But we learned from it. And then we made a lot more investments that have done really well. So even if you make an investment that's not the best investment, you might learn something from it. It might be education that you gain. Have you known about Zooms in Virginia before? 13 stores in Hampton, Newport News. Before 7-Eleven. I have no idea what Zooms are, but this guy's name is Zooms. But all right, we'll have to check out Zooms if we're out there. Thanks, Al. I think I'm going to cut it off at 2.5 hours. We're at like 2:16, so get those questions in. But shoot, people are on here. People are asking questions. I'm having fun. I can do this every Monday. And I think that's what I'm going to do. Every Monday at 5 o'clock Pacific Standard Time. I've got guests some weeks, and next week I've got a guest who owns something like 180 units. So if you're an investor and you want to talk about investment stuff, this guy's in California, has built a humongous portfolio for just a dude, right? That's going to be a fun one. But the weeks I don't have a guest, I'll just come on here like this and just answer questions. What is the main advice for someone who want to be a mortgage broker to kill it his first years? Work your tail off. Provide as much value as possible to as many people as possible. And I was thinking about this the other day while I was running. So here's my answer to this question, is that the two main things are, to simplify it, promote like crazy and do an excellent job. And over time, you'll win, right? Because by promoting like crazy, you're getting people in the door. And without doing that, people miss this part. We're like, I want to be the very best. I want to be the very best mortgage broker that ever lived and never make a mistake and know every single guideline. That's going to help, but get people in the door, get deals done. And that's how you get better. And so promote like crazy on the front end, be around a good quality team. And that's something that, Bill, who's on my team, who's out there chasing deals, we know they're going to get done in a timely fashion. Clients are going to get taken care of. They're going to get an excellent rate. They're going to get excellent terms. So he can go out there and fearlessly chase business with the confidence that if he doesn't know everything, it's okay. We're going to close it. We're going to close it timely. We're going to close it, whatever. And so that would be my advice too, is like, maybe you don't want to kill it. Well, maybe you do want to kill it, but if I look back to 2014, I did 27 deals. That was killing it. Then I did 50 the next year. That was really killing it for a second year guy. Then I did 87 and it exponentially went up. Last year, the 248 deals for 84 million. It's not likely that you can do that in year one or year two, but work towards that trajectory. Provide massive amounts of value. Never worry about deals you lose or people that don't work with you. Just go out and talk to more people. Provide more value. The first year I was in business, I went to 2 networking meetings a week, which quick math is 100 for that year. Talked to every single person in my market and promoted the heck out of myself. If you Google Matt the Mortgage Guy, you'll find me. That's what I told people. So what jobs pay the most? You see doctors, lawyers, etc. This is a tough one, Marge, because there's people who run companies, and there's tech folks that are working for Amazon, some of the high level software developers and stuff that besides getting huge salaries are getting these huge restricted stock units, RSUs. And so between those two, who I saw once, and I don't know if I should be sharing necessarily, but it's broad, right? Is somebody who is a software salesman. Some of these softwares that big companies use are expensive. And so they're selling, 6 and 7 figure software contracts. This guy was W-2'd into the 7 figures for software sales. He must have been a good software salesman. Smart guy, nice guy. Doctors, lawyers, they make good money too. If you're a pediatric heart surgeon, you might make $600,000 or $700,000 a year. If you're a good lawyer, you might make $200,000 or $300,000 a year. But really, I'll tell you this to wrap this question up. I know investors who never make more than 150 grand who own 10 million in real estate and will retire exponentially more wealthy than a doctor who made 400,000 a year and took trips and bought boats and splurged versus somebody who invested from the start and built a real estate portfolio that spits off whatever it is, 20,000 a month, and then you get $250,000 of net worth just through the appreciation and debt pay down every single year. That's where real wealth is built. So the payday isn't as important as the wealth. That's my opinion. I want to rebuild my house by taking refinance with cash out. I need 300 grand to rebuild. What are my better options? Well, Pramod, depending on how much you owe and how much it's worth, let's just say you've got a house that's worth $1 million and you owe 250. You can take out 300 grand, no problem. Then you'll have a 550 plus closing costs, call it 560 loan. And in most counties where houses are worth $1 million, your max loan amount might be 822, it might be 679, depends on the county. That's one option. Or you can look at, if you've got a really great rate on your first, you don't want to touch it, you can go out and get a home equity line for 300,000 at a small community bank. Do the rebuild, remodel, and either have a plan to pay off that 300 or do a refinance down the road to tie that 300 into your first. Lots of options. If you're in California, give me a holler. If you're outside of California, give me a holler and I'll refer you to somebody. Sade, I appreciate it. Oh, we got that one. Good luck to you. If you're going to become a mortgage broker, it's satisfying work. Help people get into homes. You help people refinance, put them in a better financial position. I've had some really, really amazing transactions where I've cried with the clients because they're able to stay in a house that they thought they were going to have to move out of after a divorce. And them and their 4 kids through refinance are going to save $900 a month. They're going to stay in their house. That's cool stuff, man. I didn't get that working for the state. Ooh, it's a tough one, Brandon. I would check the leases because FHA is going to require you to move into one of the units within 60 days. The lender may have a problem if it's fully occupied. So there's got to be a plan to get you in there within 60 days. Right now, with eviction moratoriums, could be tough. But if I were you, maybe you work something out where you offer like cash for keys. Somebody's lease is up in July. You're like, listen, I'll give you $5,000 to move out the end of this month. If they were going to be gone in July anyway, maybe you're like, oh, heck yeah, I'll take it. Then you move into that unit. Because house hacking when you're 19 in a fourplex, bro, best thing you could ever do. I've done this for so many people, especially when you're young. If you did nothing else in your life but this fourplex, and then 30 years from now when you're 50, which is still young, you got a fully paid off fourplex spitting off 4 times whatever the per unit rent is, and it's worth 2.5x what it is today. It'd be the best 3.5% down money you ever spent in your life. Why are we talking about a convenience store in Virginia or not in Virginia? Huh. Oh no, Zooms. It's good promoting, I guess. Oh, thank you. Your new go-to for good info. Buying a home at 40 years old. Hey, Tina, go check out a video I made called The Power of Extra Mortgage Payments. It's on my channel, and it's gotten all this traction. It's got like 30,000 views in the last month. I think that's what it's called. Let me see. I'm going to look it up for you so I don't misspeak. For whatever reason, people love it because it just keeps getting more views. It's getting like 2,000 views a day. The power of making extra mortgage payments. Even small little chunks, Tina, 200, $300 a month is going to have you paying it off so much faster. There's a wonky calculator in that video that I made that will help. But my only advice is that when you do that, make sure you're not paying $300 a month extra towards your mortgage and then neglecting $40,000 in credit card debt. That's 18%, because that would be silly. Pay off the credit card debt and the higher debt before you get into a aggressive pay off your mortgage scenario. What are questions that a seller's agent should ask the buyer's lender to make sure the buyer's loan has a great chance to close? DTI, cash reserves, FICO. You know what's happening nowadays, Al, is it's so competitive that I tell the agent who's putting the offer in, CC me on the offer, and then send me the listing side's phone number. I call the list side. I give you all the information you need. And I'm not sure about everybody, but when I call, I'm like, listen, listen. I don't say that. But I start off the conversation with, hey, I'm calling on 123 Main Street. My buddy Ben so-and-so just submitted an offer on your listing. I think you've been talking to him. Oh, yeah, great guy. Okay, so my client's name is Joe and Patty Smith. Made up name, right? Great clients. I can tell you that they've got W-2 income. They've got excellent credit. They've got verified assets in the bank. Ben sent over the proof of funds, so I know you've got that. I've got everything in the file. I'm ready to go. Once I press play, we can close this thing in 22 days. And so I just wanted to let you know and give you this call if you have any questions for me. And they go, okay, yeah, I actually did have a question for you. Like if the appraisal comes in short, they wrote in their offer that they're waiving the appraisal contingency. Can they really do that? Can they make up the difference? They've got plenty of assets. And I don't have to share details. I just say they got plenty of assets. And I say, Mr. Selling Agent, to be completely honest, this conversation's come up with me, Ben, and the buyer, and the buyer's fully aware. This is a super competitive market. They're fully aware that it might come in short. And I'll tell you that no matter where it comes in, they're prepared to close on this home. They really want it. And they're buying it for the long term. So if it appraises at 925 and we're in contract at 975, they've got the 50,000 to make it up. But more important than that, they've got the mindset that that's not going to deter them. They're not going to get cold feet. They're not going to back out. That's what the listing agent wants to hear, right? And so once you communicate that, here's the thing. Not every lender is going to be smooth talking Matt the mortgage guy. So I don't know if that's going to happen on transactions, but that's what should happen. And I'm telling the honest truth. I'm never making things up, but these are the type of strong buyers I have. And so I'm calling with conviction, relaying that, because that's what the seller wants to know. This thing's going to close. Is that 3.6 on a 25% down mortgage the same as if an investment property is refied with at least 25% equity? Good question. Refinance, rate and term, investment property. I've still got it up. I'll go straight to it. It might be slightly better. Yeah, it's slightly better on a purchase. Oh, you know why? Remember last year there was that 0.5 hit for all refinances, that little Fannie Freddie, little smackaroo. Was it last October? So there's a 50 basis point hit to all refinances as of last year. For this scenario that we're talking about, 3.625, slightly higher than the 3.6, cost about 45 basis points, meaning it cost about 13.65 for that rate. And the rate sheet is capped at 3.625. So that's the quick and dirty answer. You know what I should do? Nah. I should make finance videos too. Ad revenue is huge. I know, but money's only one part of the equation. I think that I could talk about it and I could get more ad revenue on YouTube, but I'm just trying to provide mortgage value. I got enough money to buy what is this, corduroy jackets? I'm set. Thanks though. I think I could too. Rhode Island to California soon because of job. I got a Facebook job. Oh, hit me up. I got one of my wife's cousins works for Facebook, enjoys it. The cool stuff about these tech companies in the Bay Area is most of them allow you to work from home. So if you're remote at all, let me know. And there's plenty of cool places. I live in Sacramento, which is about 2-hour commute to most of those Bay Area places. And if you're not required to live in the Bay Area and show up to work every day, you can buy much more. You can buy a nice house for 500,000 or 600,000 where I'm at versus a shack for 1.5 million over by Facebook. What do most people do with equity in their homes? Kid college. You know what? More like the most common thing, because I see a lot of cash out refinance, is putting it back into their house. I think there's something psychologically about that where they're like, I don't want to pull out cash and blow it. If I'm going to pull out cash from my house, I should use it to renovate my house, make my house nicer. And so that's what I see more than anything. Oh, I just got a text. Verbal acceptance of our offer in San Diego. Got it. It's so fun working with buyers when it's this competitive because getting an offer acceptance, like winning the lotto, just won the lotto. What happens if I get multiple offers on my house I have for sale, but I still haven't found a house for me to buy? This is the main issue. As the seller, and listen, I'm a mortgage guy, but I'm just involved in a ton of transactions, so I probably know as well, if not better than some realtors. You get to call all the shots as the seller. So what you do is you make your sale contingent on you finding a replacement. And then you also tell the buyers that they've got to offer you 30, 45 days of free rent back. Somebody of those multiple offers is going to be willing to give you all those things you want. And then you have the ability to spend a little bit of time shopping and putting offers forward. But here's the thing. You're going to get 10% more than your list price. You're going to get more than you thought you were going to get on the sale of your house. Don't think that you can go out and buy a house without paying more than what you thought you were going to pay. That's just how the market is. And so I've seen it, and I've got a buddy, Jeb Smith, down in SoCal that had a buyer who got 100,000 more than he was expecting on his house, but didn't want to offer 70,000 more on the house he's buying. Like, of course, that's the market you're in. You got more, you can spend more. I don't know. Average closing time you see. I just got the metrics back from my favorite lender where 75% of my deals go. And my average submitted to wire was 16 business days. So if that overlaps a weekend, 22, 23 days. If you work with a bank, not that fast. If you work with a direct lender or broker who knows what they're doing, low 20s. Appraisals are holding things up. Appraisals are really the only lag because we can get it underwritten, we can get it approved, we can get it through in very quick time. But I'll tell you what, Steve, man, if you are the type of guy who takes 4 days to get over a month of bank statements and your latest pay stub, it's going to be longer. If you're the type of guy that gets an email from my team at 2:00 and you've uploaded those things by 3:45, we're closing your loan fast. Thanks. It's good to be live, T. Thanks for coming. I'm wrapping this thing up soon. I'm 2.5 hours. I used to do this, Al. I probably would shy away from it. I don't know. I did it for investor realtor clients who were selling flips. I was like, I don't want this thing to fall out. I need this money to get back in action and back to work. I would just call and ask. I just want to know that the lender is competent. A competent lender is going to have all the I's dotted and the T's crossed. The last thing I want to do is have somebody submit an offer, get an offer accepted, have my whole team, processor, team members, doing all this work for a loan I can't close. So up front, I'm getting everything from the client. I'm offering I'm ordering the verification of employment. We're pulling credit. We're analyzing income. We're running desktop underwriter. We're doing everything. I know I can get a loan done for you if I pre-approve you. And so I want to hear that from someone I'm cross-qualifying if I'm doing that. Are these bots or these real people? At Zooms, great live stream. Oh, there we go. T just subbed. New subscriber. Oh, this is a good question. Good question, T. Thanks for joining. Low credit, 3% down payment actually get offer accepted. Here's the thing. If you've got credit where you're doing FHA loan, 3.5% down, and like if you're sub 660, 3.5% down FHA is definitely the better loan product for you. It's going to be tough. And so in my market, anything that's getting multiple offers, you're going to have a very tough time. I've got great clients, people I care about a lot that are having a tough time of it, this exact scenario. What you're going to have to do if you're one of these buyers, in my opinion, is go ugly duckling hunting. You're going to find a house that's been on the market for 33 days. And then when you look at the pictures, you realize why. It's got shag carpet. It's nasty. That kitchen is from 1964. And, it's not the type of property that has everybody going crazy when they walk through it and tour it with their agent. And so there's not multiple offers. And so that's the house. Excuse me. That in most markets that are super competitive, you're going to have to go after. The stuff that has 15 offers, it's just the nature of this market. Unfortunately, you're not going to be able to compete with conventional 25% down, waiving their appraisal contingency. Like it's just not going to happen. Oh, what's up, T? Used to live Arden Arcade, North Highlands. I'm right over by Sac State, right down Watt Avenue. So very, very close to where you used to live. I don't know where you're at now. Another state? Do underwriters want to approve you? Yes, if you fit the guidelines. But more importantly, a good mortgage broker, before it gets to any underwriter, we're going to tell you if you're approved or not. And trust, we want to approve you. I don't get paid if I can't get a loan done for you. So it's really one of those things too, where people look at it and say, I'm really a nice person. I've made all my payments on time, and I love dogs or whatever it is. Right? The external stuff doesn't matter. It's not like something that you can look at with and say, oh, this is a nice person. They make their payments on time. It's like debt to income ratio, credit score, all the boxes that need to be checked are what needs to happen. And little known fact, since you're a Spanish teacher, hace 17 años viví en México, en Querétaro, y ha pasado mucho tiempo, pero todavía lo hablo un poco. I don't have people on my team that speak Spanish, so unfortunately, it's hard to do loans for Spanish-speaking folks. But in California, I have a decently good income. Cool. Well, if it's good income, but it's low credit, you can give it a good college try in this market. And if it doesn't work out, then just work on improving that credit. Do anything you can. Can underwriters override little things, especially for self-employed, to make great income? It depends on what the little things are. They're not going to just be like, oh, you make great income. Our debt to income ratio can go up to 55%, even though it's 45 on this specific product. Or, the findings per the automated system say 45%, but the findings say that we need 6 months of reserves, only 3 for you because you make good income. No love in that way, Teddy. The guidelines be the guidelines. It's like no discretion. Hillsboro, Oregon. Shoot me an email, Matt, M-A-T-T, at mattthemortgageguy.com. I've gone 2 hours and 40 minutes. I'm in overtime. I'm not getting paid overtime, but I thoroughly enjoyed this. Thanks for everybody who joined. Hopefully anybody who watches this on replay gets value out of it. Next week, investor buddy of mine who's going to have a bunch of cool stuff to say. Happy to answer any questions then. And then 2 weeks from now, I might come on solo and do some more Q&A because it's been fun. I think this is really good. And I think that a lot of times in the comments of videos or somewhere else, it's like a one-off, one-way question asked and then I answer. This way we can be more interactive, right? And if there's clarifying stuff needed, we can do that. Loan Depot, not a big fan. I can broker to them, but not a big fan, T. And mattthemortgageguy.com. I'll set you up with somebody in Oregon. I got a great person in mind. Not a tax advisor. Ask your tax advisor. Trying to bang out a couple quick questions. or you want to get back into the market. You're not supposed to refinance within the first 6 months. It's going to hurt the person you did the loan through. They're going to get an EPO, early payoff. And so, if you want to do cash out on an investment property that you bought or primary and go back up to 75 or 80, depending on which one it is, there's no real time restriction. But if you like the person who wrote your loan, if it was me, for instance, I'd be like, can we wait until the 6 month mark so I don't get penalized? It looks bad for a broker because it looks like churning. And so there's that. All right. Thanks, everybody. I'm logging off. I appreciate everybody who joined. Every Monday, 5 p.m. Pacific Standard Time. Any questions at all you have, Matt at mattthemortgageguy.com. I'm happy to help. And in this live setting, I really like it because we can bounce stuff back and forth. All right. Thanks all. We would be good friends, Jay Ryan, for sure.